Jonathan Ferro. Lisa Brammett's back with us in a couple of days. Kelly Lyne's sitting in. Your equity market up 39, let's call it 40, bouncing back 0.9% on the S&P. Big unwind in treasuries in Friday's session. It's the unwind of the unwind, but a muted one, Tom. Yields up by 6 basis points on 10s to 153.46. Yeah. And capturing that is crude. Lower by more than 10% in Friday's session, and this morning up by 5 to 71.54.
Yeah, Brent crude 76.01 down from the 84 level that we've seen so much. We now begin a discussion this morning with Peter Hotez joining us later. And we are thrilled to bring you Joshua Sharfstein. He's Vice Dean of Johns Hopkins at Bloomberg School of Public Health. But far more than that, he has been a measured voice for Bloomberg surveillance. John and I feel very strongly we should lead with science, and we lead with a measured alert this morning, losing the hysteria and frenzy we've all felt the last 4 hours. Joshua Sharfstein, how do we constructively generate a measured alert given our fears?
Well, we have been talking for a while about the potential of more variants coming. We've said that those variants could well form in places that are under-vaccinated, and that's what we may be dealing with. This particular variant has a number of concerning mutations that resemble some of the other variants that we had. None of those variants totally escaped the vaccine. None of them were like our worst nightmare come true. And we have to go through the process of studying this variant while we continue to be vigilant and take precautions that we need to take to prevent the spread of infections. This may well not be as dangerous as other variants, but it may be have the capacity to infect people a little more who are vaccinated. We're just going to have to find out.
What will this do to the unvaccinated? I noticed this morning one of the statistics was the unvaccinated 13 times likely to die than the vaccinated. Do you presume, and you've been in the trenches on this, do you presume we will see a trend to vaccination?
It's interesting. People who are unvaccinated tend to get vaccinated when they perceive more of a risk to themselves. And so you saw with the Delta surges in the South, suddenly more people in the South were getting vaccinated. But it may take things actually getting worse before more people get vaccinated. In the meantime, this weekend, I heard people saying, well, if there's another variant coming, maybe I shouldn't get vaccinated with the current vaccine. That's obviously the wrong way to think. The more people are vaccinated, it's overwhelmingly likely the more protected that they'll be. And that will also protect the entire area from a variant that is a little bit more transmissible.
Doctor, help us understand the history of a virus like this one. Over time, shouldn't we expect this to become A, more transmissible, and B, less severe? Isn't that something we should be expecting to happen?
Over time, but how much time? It may not be over this period of essentially months that we've had with the virus, a couple of years, versus decades. So there was a coronavirus pandemic that apparently may have happened at the end of the 19th century that now may be our common cold. But, that's not a lot of solace to the people who were experiencing it and getting really sick back then. So it could happen, but it may take some time for it really to become mild. I think right now the virus is just trying to, spread. And some of these mutations make it more likely to spread. Some of the mutations may, happen to make it more severe. We're going to have to figure that out and be smart about the kinds of precautions that we take. I think really being careful about travelers makes sense in the sense of testing and vaccination. I'm not sure the kind of travel bans we've seen make a lot of sense given how far this variant's probably already spread.
Doctor, it's clearly far too early for someone like you to draw conclusions. I just wonder how much time you would need. Is it a matter of a couple of weeks, several? Do you need a month of data? What would you need? How much time?
I think we're going to start seeing, it's going to be a little bit of a, buckle your seatbelts moment, because we're going to see all kinds of individual stories before the picture really emerges. Based on the studies that have been launched, I would expect 2 to 3 weeks for a much more clear picture, but I wouldn't panic over any one headline.
Dr. Sharfstein, we talk a lot about natural immunity when having the conversation about vaccinations as well. Is there a difference in response to a variant between someone who's been immunized with a vaccine and someone who has had COVID, therefore, quote unquote, natural immunity?
Well, it may depend on which variant the people got sick to in the first place. So immunologically, you can kind of put these different variants on a tree, and it turned out the original virus was pretty close to Delta, which is why the vaccines made for the original virus work pretty well for Delta. Some of the other variants actually were very different from the original virus, and the vaccine didn't work so well. Those got outcompeted by Delta. This looks more like that. So it depends, I think, a bit on which virus. If somebody actually had one of those earlier variants, there might be more protection than someone who had Delta or the original virus or the vaccine.
Doctor, good to catch up with you this morning. An important conversation. Joshua Sharfstein there of Johns Hopkins. Tom, we started this hour, this program this morning, this week, by saying it's going to take time. It's going to take time to get a fuller picture of what this new mutation actually means for this economy, for this global economy, and for society as well.
Yeah, the coverage has been, I think, very measured all in all, but you see the media frenzy and you think the president's going to put a clamp on this. I would say, John, today, how the president addresses this is really, really important to say, let's keep going, let's move on. And John, the fact is we're moving on with a bang-up economy. I think retail sales online. I mean, John, what are you doing for Cyber Monday?
I'd already brought the Christmas tree. I did try and get ahead of all of this, Tom. I
gave
you
a tree and there's a shortage.
gave you a strong hint, and now we have Katie Lines, a Christmas tree shortage
It's a high
in
alert.
America.
We're on high alert.
To be clear, is this just fake trees or real trees too?
I think it's also real trees and fake trees. I mean, it goes to show you supply chains affect everything in the world, right? I will say, if you're in need of one, Tom Keene, Tribeca Whole Foods. That's where I got mine. And it's huge.
Whole Foods, that's beneath 59th Street.
Oh yeah, I forgot you don't tread in that territory.
When was the last time you went down there?
Nixon was president.
I think to see the guys at Oppenheimer.
Can I mention that today's word is gegenpressing?
Gegenpressing. Do you want to talk about Manchester United? Is that where you're going with this?
What is it about your Germanic coaches? Why did Germany coaches end up in England, John?
Well, the new coaches, the new crop of them, Tuchel, the likes of him, Klopp, just fantastic.
Of Liverpool, yeah.
They play this pressing game, which I think is what you're alluding to, Tom. This very high press, very aggressive, takes tons of energy. Everyone's got a role to play. They all fulfill it fantastically. And the teams at Liverpool and, of course, at Chelsea really capturing that essence of that effort. And then maybe Manchester United get a flavour of that in the months to come, Tom.
We'll see. It's like Ovechkin in hockey. Go to the net, And that's
Jim Bianco's going to have a ton to say on this, TK.
Is he?
Of Bianco Research. Absolutely not. He's going to weigh in on supply chains and what this new variant means for supply chains, the global economy, the inflation backdrop, and central bank decisions. Equities up 0.8% from New York. This is Bloomberg.
Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels. There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We've definitely seen some signs of euphoria.
A lot of people were looking beyond the virus. I think a bit too early.
We need to remain reasonably calm.
The earnings story is still quite good.
It's the fear that's driving prices, and I wouldn't necessarily get in the way, right? It's like catching a falling knife.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Getting your trading week started live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene. I'm Jonathan Farrow, together with Katie Lyons. Lisa Abramowitz will be back with us a little bit later this week. Your equity market, Tom, up 0.8%. You said it in 2 words. We wait.
We wait. It's a good bounce and all that. We wait for the president speaking later this morning. Kaylee will talk about that as well. But, John, we wait to see if this economic recovery continues. Greg Villiers saying it's humming. It's there. But this bounce this morning, I mean, it's a great bounce, but it's not a convincing bounce. We need to hear science news.
I hear you, Tom. Not many people comfortable with this move this Monday morning. We'll talk about whether you should fade Friday or fade this morning. We'll get to that point in just a moment. The view from Jan Hatzius over at Goldman, Tom, just working through the research from Goldman. I thought Credit Suisse over the weekend, but that's some fantastic stuff. This from Jan Hatzius. The range of medical and therefore economic outcomes remains unusually wide. That's going to be the case now, Tom, for the next couple of weeks.
Yeah, it is, but how do companies adapt? That's been my theme through all of 2021.
Well, they have done all this year. Let's be clear about that.
They've been doing it all year, but I wonder how the successful stay-at-home companies adapt to this, and the answer is they're going to wake up and say, let's go to work, and that's going to be the tone.
The path towards the middle of the month gets a bit cloudier, Katie Lyons. It seemed very clear maybe a week or 2 ago. The Federal Reserve, the middle of December, the Bank of England, the ECB, let's talk about it, and then all of a sudden we're talking about something else.
Well, John, you and Tom have both been saying we have to wait for more information. It's going to take weeks to get a clearer picture of what exactly this variant is and what the implications are for growth, and yet central banks have to make decisions in about 2 weeks and change on what they're going to do with monetary policy. So do they exercise caution and wait until there is more information if there's not a clear picture by then, or do they proceed with what the market had been expecting was a faster tightening given the inflation picture?
Well, let me get your take on this, and Kelly, Tom, both weigh in on this. Tom, you first. How responsive will this market be to incoming economic data? Payrolls Friday, for instance. How responsive, how sensitive will we be to that?
I was just looking at 4.5% as a survey on the unemployment rate. A lot of people looking for a better statistic than that. We'll have to see. If we get 500,000 non-farm payrolls, guess what? That's still a recovering economy.
Does that move the dial, though, Tom, if you still don't have the information you need?
I don't know. I don't have the information
to
know. Starting with the president this morning, he's got to come out and talk about getting vaccinated.
That's the difficulty, though.
That's it.
That's the difficulty, though, for market participants on Friday. Katie, how do you you respond to a really strong print if you still haven't got the data you need to work out what the Omicron variant actually means for the global economy?
Well, it comes down to how you think monetary policy will respond. What will the reaction function be if you are seeing a continually recovering labor market? You're making progress toward that portion of the dual mandate. We know inflation is there. It's been running hot. And do those two factors mean that the central banks have to react even if there is a little bit of cloudiness on the growth picture? That's the question.
A couple of themes to work through the following hour. Let's pick up on a price action. Here is your bounce. Tom said it's not very convincing. Most people agree with him this morning. We're up by 0.7% after a monster move lower in Friday's session. You see the move on a 10-year yield as well. 6.66. Do you like that, Tom? Maybe not. Up about 7 basis points on 10s to about 154 after a move lower of about 15 basis points in Friday's session. And TK, let's round it out with crude. We're up 4.9%. We had a move at 13 on Friday.
No, I forgot about this. I'm sorry. In the weekend reading, is anybody talking about an adjustment in the taper schedule after everything we've seen?
We heard from Bostic on Friday. We were having that conversation. And Katie, what did he say? Let's go. I'm open to it.
Exactly. And of course, you were talking about Jan Hatzius, John, and about his calls on the different growth implications depending on the severity of the variant. Remember, on Thursday is when Hatzius published that he expects come January, the Fed will be doubling the speed of its taper, and he also sees liftoff in June. So does he start to think differently about that calculus as we approach the Fed decision in about 2.5 weeks' time? Now, as for what is on deck today, of course, it is Cyber Monday. I don't know if you buy your Christmas trees online, Tom, but you could buy a lot of other holiday gifts online. And Adobe is expecting it to be the #1 online shopping day of the year. It could be as much as $11.3 billion being spent. Yes, prices are going up, but consumers so far have proven that they are willing to pay up for gifts. Now, of course, also going on today, speaking of policy and, of course, of the virus, the president will be giving a speech on the Omicron variant at 11:45 a.m. Eastern time from the White House. Does he use this as an opportunity not just to detail what kind of policy response will be coming, but push, as Tom has been alluding to get more Americans vaccinated? And also, how does this tie in to the president's economic agenda as Congress, or the Senate at least, returns to Capitol Hill from recess today? And then speaking of monetary policy, Fed Chairman Jerome Powell will be speaking later on this afternoon. That's at 3 p.m. Eastern time. Of course, we're going to be hearing a lot from the chairman this week, not just today, but also on Tuesday and Wednesday as he testifies before Congress on Capitol Hill. So what does he say about the virus and its implications for monetary policy? Do we get that accelerated taper or do we not?
Will he be asked about Christmas tree scarcity?
Probably.
In the last hour, Katie Lyons was promoting Whole Foods down in Tribeca. TK, my experience, Home Depot, same-day delivery, just got it done. It was fantastic.
On
a couple of weeks ago, same day on a Saturday.
Does it have green needles or silver needles?
Green needles with the lights already set.
The lights already
White
in, but
lights
then do you have
already
a light
in.
John wants to
turning
do
at the
no
bottom like my grandmother had, where you turn the different colors?
No, just set to white. White lights,
get back.
7.5 feet tall. Home Depot, same-day delivery. Home Depot's up more than 50% this year.
Do you throw it out at the end of the year on the street, or do you keep it for the? Do you store it somewhere?
We keep it.
You do.
You know, I'm very conscious about climate change, Tom.
You're a sensitive guy this morning. I'm on high alert. You're sensitive.
We'll talk about this Christmas tree scarcity through
Bring
the
in
week
Jim Bianco
as
and
Tom
save us.
tries to hunt down a Christmas tree in New York City. Jim Bianco joins us now, founder and president of Bianco Research. Jim, let's start with this one. Do you fade Friday's move or fade the move this morning? Which one?
Well, it depends on if you're short-term or if you're long-term. If you're a very short-term trader, you'd probably fade Friday's move. But bigger picture, you might want to be fading today's move. And the reason is, look, I don't know much about viruses, and I'm not a virologist, but I will say this. What is the biggest problem the economy has right now is the Great Resignation and the supply chain problem. This, with all the restrictions that we're about to get, it's not going to help that situation. It's going to make it worse. And that probably means that constraints are going to get worse. You're lucky you got your Christmas tree when you did. It might have actually been harder to get it in the coming weeks as well. And that might mean more inflation because demand for stuff is not going to change. We've already got record demand for durable consumption. We've got record demand for retail products, but yet we don't have those products to meet them. They're either stuck in the Los Angeles port or we're just not going back to work to make them. This is not going to help that situation, and it's not going to be resolved anytime soon.
Jim, you synthesize like nobody. I put you and Michael Darda on the top of the ability to synthesize everything we're talking about. Can you say that even with this news, corporations will adapt?
Well, they will adapt, there's no doubt. But what's different about now versus January of 2020, or even when we got the Delta variant in May, is we've got the economy humming, we've got people wanting stuff, we've got inflation. We did not have inflation in May, or if we did, we were firmly convinced it was transitory. We were worried about deflation back in January and February of 2020. So this is going to change the calculus quite a bit, especially for the Federal Reserve, because it's easy for them to say, if there is any kind of restriction in the economy, we'll just ease aggressively. That works when you don't have inflation. But when you do have inflation and you try to stimulate, especially an economy that's already suffering from a supply chain problem, so let's stimulate even more demand, you might wind up making it worse.
Hey, Jim, you went there. Are you questioning the Fed put with this kind of backdrop?
The Fed put should be questioned when you have inflation. When you don't have inflation, like we did the previous 30 years, then you don't have to question it as much, because the Fed put would benefit both stocks and bonds. But now, if they start stimulating, the bond market might not like it, because it might perceive that it's going to accelerate inflation. The stock market might like it, but you won't get the same reaction out of both markets like we have every other time.
Jim Bianco, so if I have a longer term perspective, forget about the traders scalping this and doing this and that weeks out. If I'm out quarters, do I change anything today?
You don't change anything today, and you might not change anything this week, but what you have to be careful of is if we get enough restrictions, you're going to see higher and faster inflation, because there's one way you can fix the supply chain problem. You raise prices enough to cool demand so that everything comes back into balance. But that's not the way we want to fix it, because that's kind of the losing way to fix it. So that's what I'd be most concerned about longer term. Does this potentially mean economic restrictions? No, everybody still wants the same amount of stuff. So therefore, the answer is higher prices or even more inflation than we've already been fretting about.
I'm willing to sell the tree, fully decorated. There's a price. I mean, there's always a price, Tom. I'm willing to go there. What would you pay for it? Thousands?
I would rather...
Are you willing to go into the thousands?
I would rather put the Christmas ornaments on vet bill
than buy my tree.
Fake tree.
Then get a fake tree. You don't want a fake tree.
Fake trees are un-American.
Jim Bianco of Bianco Research. Let me. You think fake trees are un-American?
John.
He's not American, Tom. You know that, right? So it doesn't really count.
Cutting the tree down with the chainsaw. Yeah. Hey, Jim, good to catch up. Thank you, sir. Kaylee Lyons, Jim's point there on the Federal Reserve. I can see you in the middle of Central Park with the chainsaw.
That bill with the antlers on like the Grinch, you know.
I can see that working out. Kaylee, Jim's points there on the Fed, I think, are really important going into this meeting in a couple of weeks.
Yeah, it's going to be really interesting to see how the jobs data on Friday then informs what the Fed is doing, because everything Jim was saying there is this could just feed in more to inflationary forces. At what point does the Fed have to react to that no matter what?
That meeting, a couple of weeks away. 24 hours after that, you'll hear from the ECB and the Bank of England. Tom, can you do that chainsaw impression again? Got that? What was that noise? That's what it sounds like. Fantastic. Coming up, 8 a.m. Eastern Time. Can we do this through the morning? Vishnu Turapatur.
It's a skill.
Of Morgan Stanley.
That's a joke, John. It's a skill. Get it? Skill. Saw.
Nice.
And one Canadian.
A bit niche. Yeah. From New York. This is Bloomberg.
Kaylee, that's how they say it in England, niche. You sound like the guys in
What do you say, niche? You say niche?
Yeah,
oh, come on.
You sound like the guys
I'm not saying
in
niche.
Back.
Look at that skyline, beautiful.
It's like, Get Back is like you. You can't understand
niche.
a word
What is
of it.
Niche?
They're all
English. Niche. Up 0.75% on the S&P. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A warning from the World Health Organization. It says a new Omicron variant could lead to surges of the coronavirus with severe consequences. The variant was first detected in South Africa. Scientists there said it appears to spread more easily. The WHO assessed Omicron's risk as extremely high. Airlines, passengers and businesses had to respond to a deluge of travel restrictions announced over the weekend. There was an initial spate of flight bans from Southern Africa. That has given way to wider-ranging measures that will make travel more expensive and less convenient. OPEC and its allies will discuss the impact of the Omicron variant at their meeting this week. That's according to Russia's deputy prime minister. It's another sign that the OPEC Plus coalition may reconsider its planned production increase in January. And shoppers returned to stores in the U.S. on Black Friday, but traffic remained well below pre-pandemic levels. According to Sensormatic Solutions, visits to stores and shopping centers rose 48% from a year ago. Still, it was down some 28% from 2019. And in New York, final jury selection and opening arguments are set for today in the trial of Ghislaine Maxwell. The British socialite is accused of grooming underage girls for sex with the late financier Jeffrey Epstein. She faces as much as 40 years in prison. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
Crypto, you have a world of young people that want their own financial system and their own culture. and it is very powerful, and I'm a big believer in it.
Day jail time for cutting Christmas trees in Central Park. Is that true, Tom?
Title 18, Chapter 1, Section 18,
90 days.
129. 90 days or up to $15,000. Now, I'd be getting a smaller tree, so it wouldn't be as large.
You'd take the cash fine. 15K.
You know,
that's material.
That's a material.
90 days in jail is material
buy
too.
John's?
Yeah.
Probably cheaper just to buy mine, but he's so against fake trees, apparently, Katie. He will not go there. Katie Lyons this morning, in for Lisa Abramowitz. I'm Jonathan Ferro, together with Tom Keane, as always. Here's your price action in the equity market. The S&P 500 with a bounce from Friday's crater. Can we call it that? I think
yes.
We
we cratered.
The
S&P crushed. We're on a high alert.
32 advances 0.7%. Yields are higher by 7 basis points to 154, and a turnaround in crude, Tom. 71.54, up 5%.
It's coming back. For those just tuning in, we were down earlier, agony and all that. We bounced up nicely. We've come back a little bit on the bounce up here. I'm watching the VIX, 25.10 on the VIX. It was a 24 handle when we started off the morning. Right now in Washington, Joe Matthew joins us, Bloomberg Washington correspondent. What's the power of the middle of the Democratic Party right now? The president speaks today. He'll be speaking to the nation and to the elections of 2022. What's the power of that middle ground?
Well, I think the middle ground today is going to be COVID. I mean, this has been just a massive distraction. If you're going in terms of the midterms here, the way the president is dealing with this is going to be key. And I think today he's got a call for calm, be consistent, acknowledge what we don't know here, and point to what's already been done. If we're going to extrapolate this and talk about potential successes or failures with the 22 midterms, a lot of it is going to come back to the way this president handled COVID and the credibility that he may have acquired in the process. You have to remember today, we actually have pretty good protections with international travel. You have to be fully vaccinated. That's something the president had in place by the 8th of November, and he'll point back as well to his 6-pronged plan that people, including me, made fun of at the beginning of September, because why 3 prongs aren't enough, I don't know. But it included this employer vaccine mandate that will take form through an OSHA rule coming in January. This president might look fairly well prepared as he speaks to the American public.
So, Joe, you and the president had a scone or a sconce, whatever they're called, at Wicked Island Bakery this weekend out in Nantucket. And what he would have talked about is he doesn't want to do a George Bush. And I would suggest, Joe, that all of Washington, both parties, are hardwired off the failure of the Katrina response, which is to get out front of it. That's really what we're dealing with right now.
That's right. That's right. And I think this president says, we've been out in front of it. We got you through Delta. We've handled travel. We're dealing with vaccines and masking despite the political implications. And look at this. We've got a new variant here, and America is in a fairly good place to deal with it, instead of saying, oh, my God, we need to shut down the airports here and we need to start creating policy. The biggest obstacle for this president has been politics, the politicizing of masking and vaccines when it comes to COVID.
But speaking of the politics, is there really, between messaging between Republicans and Democrats, is there any party that isn't on board with this, or is there actually consensus in Washington among, the executive and legislative branch, those policymakers, just not among the populace?
Well, when it comes to COVID, look, I don't have to tell you that the idea of masking in schools, the idea of masking at work, the idea of mandating vaccines has been very controversial and resulting in litigation as the president tries to pursue this mandate, this OSHA rule for companies that have more than 100 employees. He also, of course, already put one in place for federal contractors. So it's difficult to answer that specifically with regard to legislation or how most of the mainstream parties are handling it. But when you get down on the local level, the state level, the discourse that we've heard between this president and a number of Republican governors has been less than productive.
All right, but at the federal level, of course, this is not the only item to consider. It's not the only item on the agenda as Congress returns from recess. They only have 10 working days in theory on the calendar before their next recess. Are we just going to kick all cans down the road until they come back for the new year?
Well, we're going to kick one big can, and that's government funding. It looks like there will be a continuing resolution that they deal with by the end of this week. Of course, it's December 3rd. We've been talking about this for weeks. Here we are again with really no progress on this. The question is, what happens to the debt ceiling? That also was supposed to expire on the 3rd of December, but it looks like, according to the Treasury and the Bipartisan Policy Center, that lawmakers will have a couple weeks to play with there. Are Democrats finally going to handle this on their own through reconciliation? That's a big question right now, as Mitch McConnell stands by his guns and says he won't go near it. Republicans do not want to deal with the debt limit. There could be maybe some backroom negotiating, though, as Chuck Schumer and Mitch McConnell have met on this, to at least create a scenario in which Republicans don't try to slow the process or muddy the process through extended vote-a-ramas or trying to attach a lot of amendments to whatever Democrats come up with here. This is something that needs to be dealt with now. We're all talking about a variant this morning. This is arguably much more urgent for lawmakers and for Washington to deal with.
Hey, Joe, always good to hear from you. Bloomberg's Joe Matthew there. Don't miss Sound On Bloomberg Radio weekdays at 5 p.m. Eastern with Joe, Monday to Friday. Looking forward to that one a little bit later. Here's a call that would have some big political consequences, I'm sure, Tom. It comes from JP Morgan and the equity team. Brent prices will reach $125 a barrel in 2022, $150 a barrel the year after, due to a lack of spare capacity. Those numbers again, Tom, just in case our audience need a double take, they might do. Brent will reach 125 in 22 and 150 the year after on a lack of spare capacity.
This is a complete shift, and what's so important in this statement from JP Morgan is who it comes from, John. This is Christian Malik, who's off their London desk, and he's an equity analyst. I mean, it's different than Ed Morse or Francisco Blanche and the others. It's not a broader strategy call. It's synthesizing in their global economic view, their global commodities view, right down to the granularity of what it means for the oil company.
They say, Katie, that true OPEC plus spare capacity next year will be 2 million barrels a day, below the consensus estimates of 4.8 million. That's one heck of a number, basically double where we are trading this morning.
Well, and to be fair, you actually have seen that reflected in the production hikes that OPEC has put into place thus far. They actually haven't produced as much as now is allowed by quotas. They're not actually producing at that level. So I wonder how much that translates into what JP Morgan is saying here. I think it's also interesting, the U.S. part of this, they say predicated on that $150 a barrel oil call is slower than expected CapEx response from the U.S. and other non-OPEC producers. So those shale players, maybe they just want to keep their discipline, and they're not going to be pumping that much more either.
John, what's so important here is the tightness of the Marshallian cross of supply and demand on oil. We all know that. That's not news. The key sentence here is OPEC Plus depends on the efficacy of the spare capacity, the amount sloshing around, set to fall to a 25-year low of 4%, down from an average of 14%. John, that's a huge delta.
OPEC Plus will meet a little bit later this week. Tom, can you imagine the politics of 125? Of 150?
No, this is not in the market. No, I would state unequivocally this is not in the market. You know, at 80 and we're bouncing around here. I think we framed out 90. Maybe with a timeline we framed out 100. That's it.
This is a Brent call on WTI this morning. Where are we? 71.44, negative 4.8%. Coming up on rates, looking forward to catching up with Edward Al-Husseini, Senior Global Rate Strategist at Columbia Threadneedle. Your equity market this morning up 0.7% on the S&P, advancing 31 points. Yields higher by 7 or 8 basis points to 154.83.
Carl Weinberg says, don't cut a tree down in Central Park, Tom. You have to go up north. There's plenty of trees.
Go up north. How far up north?
I think it's like 400 miles.
And just keep going.
Canada. Just keep
going until you find a tree.
the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time?
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Seeing vet bill there with antlers on in the middle of the night in Central Park. Tom with a chainsaw, which might look dangerous, Tom, in the middle of the night in Central Park, cutting down a tree.
No, we make jokes about it, but actually it's really serious, and the city takes it very, very seriously. I went up a couple years ago, and I was out on the north side, just beyond the Harlem
Just
Mirror,
having a look.
And just looking around, and, you know, the officer stopped me and said, we don't care that you work for Mr. Bloomberg. That was what came out of his mouth.
I hope that's not a true story. From New York City this morning, good morning to you all. Tom Keane, Jonathan Ferro, Katie Lyne sitting in for Lisa Abramowitz. Lisa will be back with us a little bit later this week. Here's the equity picture for you. We bounced back up 0.7% on the S&P, advancing 31 points. On the Nasdaq, up 0.8. On a Russell, up 9. We back away from session high. Switch on the board and get to what's happening elsewhere. We've talked a lot about crude already in this turnaround, up by just 4.8% relative to the move low we saw on Friday. It's not a big move. Look at Aussie yen. Aussie yen had a move of 2.6% in Friday's session. So if you take the Aussie, that kind of good risk proxy, take the yen, that haven status, Aussie yen, negative 2.6% on Friday's session. Today, Tom, Aussie yen is a move of 0.5%. It's not a major move.
Let's go see the Pacific Rim. I mean, I'm going to take it across from the south to the north there, and it's a huge Pacific Rim proxy, John, along with Asia DXY. And the answer is we don't know. You mentioned it earlier. Zero COVID is the theme in Asia.
In China, yeah.
And you wonder with Omicron, I mean, how are they going to handle zero COVID?
Japan shutting down its borders to foreign travellers as well. The restrictions are coming back. And Tom, as you've said all morning, we've got to wait. We've got to wait for more information.
We have to wait, and that's what the president's going to say clearly in the 11 o'clock hour today. You know, we'll have to see. What are individual stocks doing?
Well, let's talk about the bond market before we get there, Tom.
Okay,
2s, 10s, and 30s. Your turnaround of the 2-year yield looks something like this, down 14 basis points on Friday's session, and now just up 5 TK to about 55. I tell you what, that meeting, Kelly Lyons, in the middle of December for this Federal Reserve is going to be absolutely fascinating if we still don't have the information we need to get some clarity on this mutation.
Yeah, we don't have the information. The Fed may have to make a decision without that information, John. And do they then decide to stay the course, stick with the pace of their tapering of asset purchases, or do they decide to accelerate, as we've seen a number of Fed officials drumbeating to over the course of the week, including on Friday? Or over the weekend when Raphael Bostic spoke, he didn't seem that worried about the variant and what that would mean for the implications for the pace of tapering.
December 15th is in the diary, your meeting for the Federal Reserve. Now we can get you some single names, some stock movers. We can do that with Romain Bostic. Morning, Romain.
Hey, good morning, John. Of course, we talk about what's going to happen, of course, in a couple of weeks here. But, of course, we came into this month really thinking about the idea here that look, stocks were basically searching for some sort of direction. It had a lot more to do with inflation and some of the macro issues. Now, of course, it's about Omicron and that COVID variant here and how folks are going to respond. Here you shift up the playbook. A flurry of notes out this morning, kind of providing sort of a mixed guidance here. Some folks saying this is a buy the dip opportunity. Other folks say you really need to sort of reassess where you go. What is moving today? You got Moderna higher by about 10%. Remember, we started this month with Moderna ceding its crown as the best performing stock in the S&P 500. It regained that title on Friday with that 21% move, 10% here in the pre-market. BioNTech higher as well. Both companies talking about that they could potentially, Tom, have an Omicron variant ready within a couple of months.
In your reading, did you see any capitulation of the S&P 5,000 people?
The S&P 5,000 people, no. Most of the people who are bullish, who are basically saying that we're going to go into next year in the 4,800 to 5,000 range, have basically stuck by their guns on that. The idea here that this is more of a speed bump, that this is probably a little bit overblown, and that some of the short-term pain that we're going to feel here in the markets and even potentially in the economy will be short-term, Tom.
We'll have to see. What else do you have?
Well, flip up the board here, and you can see some of the rebound that we're seeing in the airline stocks and Carnival Cruise and a lot of the sort of going out stocks. You've been talking about sort of the great Treasury rally that we saw last week. That's kind of reversed itself back above 150, and that's given a boost here to some of the bank stocks, Tom.
Romaine, thank you so much. I'm looking at the VIX, 25.01 on the VIX this morning. It was 24 handle, a little bit soft here in the last hour, maybe some steadiness right now. Edward Al-Husseini over the weekend wrote a wonderful note. He is senior global rate strategist at Columbia Threadneedle and provides wisdom this morning. Edward, I love what you said about minutia. I'm calling this Minutia Monday. We've been more into the minutia with Omicron than we've been in ages and ages. How do you keep a big picture if it is Minutia Monday?
Yeah, fantastic. And, you know, the context here is, look, the virus and the evolution of the virus has shaped everything in the course of the past 18 months. It's shaped policy, both on the fiscal and the monetary policy front. It's shaped labor market outcomes, and it's shaped how the consumer and corporates have responded, again, in the course of the last year and a half. So this is a good opportunity to refocus on those themes and take a look at how they're likely to evolve over the next, let's say, over the next 6 to 12 months with this new risk that's front and center of us right now.
Is the global rates theme to make money or to not lose money?
At the moment, I would say it's more not to lose money. You know, we're starting with levels of yields, particularly in the longer end of the curve, that you know are relatively low. Let's put it that way. Again, 30-year yields closer to 180, which is the low for the second half of the year than they were, you know, even in the middle of kind of the first quarter when we had that significant move higher. Inflation is closer to 6%. We've had significant fiscal stimulus that's working its way through the system. When you look ahead, I think we have several scenarios where rates move higher, particularly if inflation turns out to be more persistent and the Fed's more forceful in squeezing it out of the system. But at the same time, we have the economy likely to slow as fiscal stimulus steps back. So there's a balance between these two factors that doesn't give us a lot of directionality. So I would say it's important to be quite defensive.
So, Ed, are you saying that it really doesn't matter how quickly the Fed tapers if they finish halfway through next year, if they finish 3 months from now?
I think it matters. It creates a lot of room for them, obviously, to tighten earlier and to tighten potentially a little bit faster. But I think it matters a lot more for the front end of the curve and the belly of the curve than it does to the long end. You know, the long end has not moved that much, even as we've priced, you know, almost 3 hikes into 2022 over the course of the last quarter or so. So the flattening theme in the curve, I think, has caught a lot of people offside. I think a lot of people expected the curve to steepen as the Fed brought forward hikes.
How much of that do you think it's that concerns around the virus and just any uncertainty out there outweighs whatever happens with Fed policy because there's still going to be a bid for treasuries?
I think it's definitely that. I think it's also sort of the balance between two things, which is, first, rates can rise in the short to medium term as the economy recovers, as the labor market recovers in particular, and as we get a look at how inflation will settle over the course of the next year. At the same time, the longer term structural forces that have been bringing rates down, particularly longer nominal and real rates down over the course of the past 3 decades, they're still with us, and they've, if anything, accelerated in the course of the pandemic. So it's these two forces coming together that will determine where rates settle over the next, let's say, 1 or 2 years.
Edward, how do you respond? And I'm catching you unawares here that's unfair to you. With J.P. Morgan modeling out a persistent $80 plus Brent crude with surges as high as $150 a barrel over the next 24 months. What does that do to your world if and when we would see that outlier call?
Yeah, I mean, it's interesting. In rate space, you immediately start to think about break-evens. That's the closest proxy that we have for oil moving to those sorts of extremes. And if oil ends up there, break-evens will remain elevated. If anything, right now, the starting level of break-evens is relatively high. We're consistent with inflation averaging north of 3% over the next decade. That's quite unlikely if the Fed's reaction function remains intact. Now, if oil goes to $100 plus, particularly if it does so relatively quickly in the next 1 or 2 years, yeah, you can see those break-evens remain, relatively elevated.
Ed, good to catch up. Good to hear from you, as always. Ed Al-Husseini there of Columbia Threadneedle. TK, it was a week ago we heard that Chairman Powell would get a second term. It feels like a lifetime ago.
It does. I was thinking the same thing. It's like 1 week ago, and John, you go to the jobs report, and who knows what we'll see there. And I'm going to go back. I'm sorry, I'm getting the details on this J.P. Morgan note.
Sure.
And this is somebody who went field by field to try to calculate that spare capacity. And then normal is, let's say, 14% spare capacity. And we go down to what, as an amateur, I'm speaking, of 4% spare capacity, a 25-year low. It's stunning.
You're right to go back to it. Kelly, it gets your attention. 125 on Brent next year, 150 the year after. They think we get a lift, and that lift sticks and more.
It's quite a headline. I have to wonder, too, if this assumes that you won't get any kind of Iranian crude coming back onto the market, because we also have to keep in mind those talks are resuming in Vienna again today through proxies. And granted, we've seen many, many rounds of talks that have come to no fruition of any kind. But do you actually end up seeing the removal of sanctions? Because that would actually bring a lot of capacity back onto the market. I guess this is operating under the assumption that that won't happen.
John, what's so important here is, I look at the chainsaw we were talking about earlier, and I've got a 9.5 ounce gasoline capacity in the steel saw. And,
how much does that cost?
you say it's not a lot, but you got to refill that puppy.
What is this one? I like this.
You got to refill
You've got the honors here. Do you want to explain this to our listeners on radio? What I can see on the screen right now?
You're advantaged on radio now because it's the beautiful walkway of Central Park, which I have actually had the privilege of sitting in during a snowstorm like that. And folks, they've got me with a chainsaw out there. Those are
and a
oaks.
Santa hat.
Guys, this is Rachel in the control room. Rachel, those are oak trees. Those are not Christmas trees. We wouldn't be going.
You wouldn't go there. That's just one of the entries, Tom. We had two. I believe we've got a second one as well.
We've got it. Thank you for listening and putting me out of a job. Can you see the 108th mayor looking at this and going, Tom, I'm not amused?
I think that particular mayor might be disappointed on more than one occasion,
yes,
for more than one reason, perhaps.
He's got a whole list of...
Yes, and I don't think that list is going to end here. I think you'll keep adding to it over time. If you're just tuning in, your equity market's up 36 on the S&P. We turn around a little bit. We're up 0.8%, and we wait. We wait for more detail.
Really?
You're going to take that call in the break?
I'll take the call in the break.
You take that call in the break. Up 7 basis points on 10s to 154.66, and crude 71.73. J.P. Morgan looking for Brent.
150.
Looking for Brent to go to 150. Not next year, the year after. Next year, just 125.
That is a wow wake up.
Okay, coming up 8:45 Eastern. Peter Hotez, the Baylor College of Medicine Dean of the National School of Tropical Medicine, a man you want to hear from a little bit later this morning.
With the First Word News, I'm Rishka Gupta. The World Health Organization warns that the new Omicron variant could fuel coronavirus surges with severe consequences. The agency calls the variant's risk extremely high. Omicron was first detected in South Africa. Scientists there said it appears to spread more easily. A number of nations have now imposed travel restrictions to try to contain the variant's transmission. Moderna says it could have a new vaccine ready to fight the Omicron variant by early next year if required. That has the company's shares rising. Meanwhile, BioNTech is trying to adapt its COVID vaccine to handle Omicron. The German biotech and its vaccine partner Pfizer put plans into place months ago to ensure a new version of their shot could ship within 100 days. France has agreed with European allies to take new steps to clamp down on people smuggling in the English Channel. Last week, 27 migrants died trying to reach the UK. The European Union's border force will begin flights over the Channel later this week. And the most high-profile black figure in luxury fashion has died. LVMH's star designer Virgil Abloh has battled cancer for several years. He was 41. He's known for his influence on streetwear and sneaker culture and for his success in revitalizing Louis Vuitton. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Leanie Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I look at the opportunity we provide, and providing access to information and knowledge, I think will end up being on the right side of history as well.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
it turns out that the vaccines are perfectly effective against this new variant, prices should be above $80. I think the market continues to tighten from here into 23. They will continue to bring back production, and the market's going to need it. We just don't have production anywhere else.
And Rita Sen there, the Energy Aspects founder and director of research. From New York City this morning, good morning. Tom Keene, Jonathan Ferro, together with Kelly Lyons. Lisa Abramis will be back with us in a couple of days. Your equity market up 0.8% on the S&P. Yields higher by 7 basis points to 154.66. Euro dollar just south of 113 at 112.86, negative a third of 1%. And a moving crude, a bounce back of 5 percentage points and change to 71.69. And here's the call. Tom, you brought it up again from JP Morgan and the team off the London desk in Europe. We see long-term $80 a barrel Brent as the marginal cost to deliver a balanced market beyond 2024. Incorporating our model of OPEC plus true capacity, we expect oil to overshoot to 125 in 22, 150 in 23. That's on Brent, Tom, and that's a big call.
They really count. What I like about this research note, John, is it's countable. They really go field by field, and they really try to count up the spare capacity, the microeconomics of supply and demand within this, and they say OPEC Plus is in charge.
Questioning the spare capacity that OPEC Plus actually has, Tom. This morning a lift. Brent crude 76.14. The call from JP Morgan and the team out of Europe. They're looking for 125, then on to 150 through the next couple of years.
What we've learned so much, folks, is how this is a market of 5, 10, 20 stocks, or maybe the cyclical's doing well, or the bank's doing well, and everybody else having a really tough go of it. David Wilson has gone back and looked at a Mexico and South that harkens to 1994, 1998, and on, crisis to crisis. David, it's about the Latin American equity markets, and I see the Colombian market where you've got, they're down 9%, but currency adjusted, they're down 22%.
Yeah, absolutely. And that's part of the mix here, because what we're talking about is a comparison between the MSCI Latin American Index, which is indeed dollar denominated, and the S&P 500. I saw this originally in a chart the other day, or a report from Michael Hartnett over at Bank of America, who's their chief global equity strategist, and it really jumps out in terms of the historical comparison. The MSCI Latin American Index starts at the end of 1987. Let's put that in context. And so it's now at its lowest level relative to the S&P 500 since January 1988. So just a couple of weeks after the calculations began. And it's down 89% from a peak back in October 2010. At least it was a couple of weeks ago when the ratio set its record low. Got close to it on Friday, closed just above it. Nonetheless, I mean, this weakness has been going on for years and years, and, there's more of it showing up this year. And it isn't just, Colombia, like you mentioned, Tom. You look at Brazil, you look at Mexico,
right.
You look at other countries in the region. They've certainly had their share of weakness.
Does Mr. Hartnett mention that this is a value trap to avoid, or does he go long Latin America on weak U.S. dollar?
Well, that becomes a question. It was more of an observation than a recommendation, really. And that becomes the issue. I mean, at what point do you get any kind of, shall we say, reversion to the mean? That is an open question at this point. And given the weakness we've seen over years and years in Latin America, it's a challenge to say, the bottom is in.
Well, Dave, Latin America obviously encompasses a number of different countries. Where is the biggest point of weakness?
Well, there's a lot of it to be found across the markets. I mean, you look at Brazil and the challenges that country's had under its president, Jair Bolsonaro. That's certainly one of the biggest markets in Latin America in terms of stocks, and, that's an area of weakness. Mexico, you could argue with oil prices is doing okay in relative terms nonetheless, having its challenges as well. And you go across markets, and it's easy to find declines of 20% or more in dollar terms this year at a time when the S&P 500 is up more than 20%.
Well, and obviously what's different between the U.S. and a lot of Latin American countries is Latin America is tightening and tightening quickly, trying to combat inflation. Here in the U.S., we have inflation and policies going a lot slower. Is this gap going to only get more wide once the U.S. starts tightening as well?
Well, I mean, that becomes the challenge. It's more of a matter of pace of increases down the line. At this point, what we're seeing, indeed, well taken. You've got a number of countries in emerging markets, not just Latin America, that are moving to raise rates to try and rein in price increases. And so it becomes a matter of when the Fed finally ratchets back on bond buying and starts raising rates. Well, how do they move relative to the rest of the world? In this case, Latin America.
David Wilson, thank you so much. Greatly appreciate it this morning there on Latin American dynamics. John, it's been a huge call. To me, it's always weighted back to U.S. dollar, and that we've had that David Bloom, that Mark McCormick resilient dollar this year, and that doesn't fare well for EM.
Yeah, and if things start to slow down, or at least people begin to think that things will slow down again, Tom, you know what's going to happen. The dollar will get stronger. We could see that all over again. I'm looking at this equity market right now. A close on Friday just short of 4,600, and going through some of the calls for next year. 5,300 on the S&P, the call from BMO and Brian Bowski. That's the most bullish that I can see at the moment. David Costin over at Goldman at 5,100. RBC's Laurie Calvasina, all good friends of this program, 50-50 on the S&P. They're the high-end calls, Tom. At the low end, we're looking for 4,400 over at Morgan Stanley. Mike Wilson of the team. Savita Subramaniam has been less constructive on this equity market with Morgan Stanley through much of this year. Over at Bank of America, they're called 4,600 for year-end 22. Just a flavour of some of the calls coming out on this benchmark going into next year.
And to see a revision not only off the president's comments this morning, but also revisions off the science that we see as well. John, I just did a very loose extrapolation. Folks, this is nothing fancy. I just took a Bloomberg and eyeballed it on a Monday morning radio. You can really do that on Bloomberg Radio. You can eyeball a chart on Bloomberg Radio. And the extrapolation of the bottom of 2020 out to $150 a barrel on oil is late summer of 2023. That's if we keep this trend going.
What a rally it's been. And to be clear here, I haven't seen anyone change any forecasts off the back of what's happened with this mutation to this virus, Kaylee, over the last week, over the last few days. I've not seen a thing. The only thing we can do is just go through the incoming information. The information so far suggesting the cases that have been seen in South Africa have been mild to moderate. That's the good news, at least so far. And if we get any changes to that, we'll change things. But ultimately, for market participants, they can't wait around. So it was sell now and ask questions later, and we wait for the answers to those questions through the next couple of weeks.
Well, and it was ask questions later in terms of the policy response as well. We saw instantaneously places like the UK barring flights from South Africa and its neighboring countries immediately before we had those answers. So I wonder if you start to see a reversal maybe in some of that policy response, that starts to ease, because again, there's so much that we don't know. That doesn't apply to just markets, but really policymakers across the board.
So you need a PCR test to go into London now, Tom. And then before your second day, you need another PCR test, and you should self-isolate until you get a negative result. That's what your entry into the UK will look like from later this week.
I'm ignorant on this, and I got to get smarter because I am traveling. John, do you carry PCR tests with you in your luggage?
You have to pre-order a PCR test so that the government knows you've already paid for one and ordered one when you land in the UK. I'm not sure you can actually carry it with you. I think that they have to deliver it to the address you're at. At least that's my experience of it, Tom.
I'm sorry, folks. I'm amateur. I got to get read in.
We're all trying to figure it out for the Christmas holidays. From New York City this morning, good morning to you all. Tom Keene, Jonathan Ferro, Katie Lyons, your equity market with a lift up 0.8%. From New York, this is Bloomberg.
目前眼前状对我们军方来讲的话，我只跟委员报告，是我从军以来40多年以来看到真的是最严峻的时候。要翻台的话，他目前有这能力，都有的啊，但是要看怎么一个结局。说我们不做任何挑衅啊，但是说把他激怒了，就跟我们人一样，你把我激怒了，我手上能力我也会发挥出来。所以2025是我们研判要全面啊，我们这样研判的。
China has, I've spoken with Xi about Taiwan. We agree, we'll abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Hello traders, how are you doing today? Are you ready to make a trade? We're going to place an order to sell short Bitcoin, and the price I'm looking to sell 57,506. Okay, 57,000. Okay, I'm trying to find the price I'm looking to sell, just right here. I will adjust. So you've got the strategy, you know what to do. For other people who don't have the strategy for just following my trades, please place your order at 57,506 and wait what's going to happen next. We need to place an order a little bit away from the price because it takes time, especially with Bitcoin. It's kind of volatile market right now with Bitcoin, end of the year also. So lots of people buying or selling Bitcoin, and we have to wait until the price will reach necessary level. Okay, guys? For the people, you know what to do because you have the strategy and you know how we trade. I'll speak to you later after we'll get filled, and I'll let you know what's going to happen next. Stay safe, guys.
John Farrell, we're all on the virology watch.
Yeah, we are, and I think we need to get away from layering speculation on top of speculation here, Tom. As Jan Hansis of Goldman put it, and I keep going back to that research note, the range of medical outcomes is incredibly wide, therefore the range of economic outcomes is still incredibly wide. And I know that's not much help if you're in markets right now, but it's our job to sit here and say, we've got to wait before you draw any conclusions whatsoever about this new variant.
We're going to take a measured response to what we see here, some of the frenzy out there. We're on high alert. No, we're not. We're on measured alert. And John, the measured alert to me is we really haven't seen adjustments by strategists off the shock of Friday.
Yeah, and they can't, Tom. They can't before we know a couple of things. Is this one more easily to transmit to other people? Does it more easily transmit? Okay, let's get through that. Is it more severe? Are the symptoms more severe? Okay, if they are, then we've got a different thing to grapple with. And Tom, ultimately, can the vaccine still target it well enough? They're all the three things we've got to work out, Tom, through the next couple of days, the next couple of weeks. And it could take 2 to 3 weeks to find that out. So you've got to go from there to a Federal Reserve decision in the middle of this month.
Right.
And I think they're stuck between a rock and a hard place at the Fed.
Kaylee, I'm going to be rude here and stay with John Farrell for a moment. John, this headline out is stunning, and it's a cultural headline, which, John, you've reported on many times from Frankfurt. 6% inflation in Germany is not 6% inflation in America.
50 basis points north of the median estimate moment going into an ECB meeting on December 16th. So you've got the Fed on the 15th, the ECB on the 16th, and we're having a very different conversation. So let's set the stage as follows. So the Federal Reserve are having a conversation now about accelerating paring back asset purchases. At the ECB, we're having a conversation about how much flexibility gets taken from the emergency pandemic bond buying program to the more traditional bond buying program over at the ECB. So pulling back at the Fed, ultimately, it's a change of character at the ECB.
Kayla, you were reading in for the 5 a.m. show as well. What is the single research piece this morning that gave you clarity?
Well, there's been a number of them, Tom. I think many of them, as you both have been alluding to, is there haven't actually been that many changes in terms of what the implications are going to be of this variant, because we just don't know yet. And what does a day like Friday actually even mean? Was it really just a sell-off based on COVID-19, or was, as John alluded to and Peter Cheer over at Academy Securities has pointed out, it was something else?
Let's get to the data right now, John. I want you to jump into it. I'm going to mention Euro 112.81 is still a weaker euro. Didn't get to a 111 handle.
You wonder what the front page is of the Bild will look like, the Bild newspaper in the coming weeks, coming days, Tom, off the back of that inflation print. If you whip through the price action, your equity market has a lift, yields have a lift, crude has a lift, euro dollar on the back foot to 112.80. But there's the move in crude, 71.45, up by 4.8%. On crude, Tom, we've had a lift on Brent and WTI. In the bond market, yields higher by 7 basis points to 154.49. And just to build on something Katie said,
please,
the move on Friday was so much more than just about a new variant. We've got so much more to grapple with here. Credit spreads are near the wides of the year. Not quite there, Tom, but approaching them. And that's something that gets your attention. I've heard a lot of people talking about the back end of 2018, a repeat of that. I'm not sure we're there yet, Tom. That was a very different scenario. But credit is a place you need to keep focused on at the moment, not just this equity market after the vicious move on Friday.
For global Wall Street, the last 4 trading days, a Standard & Poor's 500, a 4.6 standard deviation move from the enthusiasms down to the shock of Friday. Right now, and this is an immense joy, off the Morgan Stanley desk, Vishy Tirupati is Global Director of Fixed Income Research, in an always interesting and fractious and healthy Morgan Stanley debate. Vishy, the heart of your research note and the collegial response that Steve Roach invented is the idea of a 3.6 American unemployment rate, and you say the Fed won't raise rates to that wonderfully low unemployment rate. How does that happen?
I think the Fed will look at two things. The Fed will look at has the twin mandate of managing inflation as well as getting to full employment. We think that over the course of next year, we will begin to see participation rate pick up somewhat, and we will inch closer to where we were before the pandemic. And we think that our economists, really, to be clear, we think that we get to that point of a liftoff in the early 2023, which is somewhat out of consensus view, I would say.
Just pair that up with your view on credit, Vishy, that patient view on the Federal Reserve with your view on credit.
So I think the view on credit, two things here. One is that when you think about credit, you think about defaults. And the linkage between economic growth and credit directly is through the default picture, and that default picture remains very constructive. Given that the defaults are at such low levels today, we might see a slight pickup in defaults, but overall, defaults, we have pretty benign outcome for defaults. Defaults will remain below the long-term average. What we had been expecting, what we have seen over the longer period of time, we will see defaults staying well below that long-term average.
That's the good news. The credit story is good. As you know, the credit story is expensive, and that's what we need to discuss a little bit more, Vishy, and I imagine that's where you're going next.
Right. I mean, absolutely, John. That's exactly where I was going. The markets are anticipatory. Markets know a lot of this, and a lot of this good news is already in price. So, and if you start looking at where is the incremental opportunity in the credit markets, we think that incremental opportunity is more in the high yield sector as opposed to the investment grade sector, and within the high yield sector, more in loans than in bonds. And our reasoning is very, very sort of straightforward. This is the time we think is to take default risk, because we expect it to remain well below the long-term average level. We expect the better opportunity is taking default risk over spread risk. Spreads are, even though in the last few days we've seen some widening, the spreads we still remain on the tighter end of a say 24-month spectrum. So we think the best strategy for credit is actually take default risk. That's what points us towards high yield, and within high yield points us towards loans as the best way of taking default risk versus taking spread risk.
Vishy, how do your expectations of how much supply, just straight up issuance, there will be in 2022 factor into this?
It does. I mean, we take all of those factors into account. Supply, we've actually gone through a pretty robust supply even in the last month. I mean, this year has been a pretty robust supply period. We do take supply into account. We take into account what we expect to be the effect of taper in the market, and all of those things we are reflected in our expectations about outcomes.
Speaking of the taper and the effect in the market, if the Fed doubles its pace of pulling back on stimulus, if it at least doubles or accelerates the way that it tapers, what's the implication of that?
So I think, a doubling of the paces, I would have said before Thanksgiving, I would have said that more of that is getting priced into the market. Certainly with this new information on Friday with the Omicron variant, a lot of those questions, which I think John rightly said at the beginning, a lot of the things are unknowns and we really don't know what's, we still have to wait for that to be resolved. So with a faster withdrawal of accommodation, in some ways, you can put that, would be broadly, somewhat negative to the credit markets. But I think in the overall scheme of things, which is, I go back to saying, where should we take credit risk? Again, bet on defaults and not on spreads.
Vishy, great to catch up. Can I just say I've really enjoyed the outlooks coming out of Morgan Stanley over the last couple of weeks, so thank you for sharing them, Vishy. It's good to see you. Vishy Tirupati there of Morgan Stanley on your credit market and the march towards Payrolls Friday. And let's be clear about Payrolls Friday. I've got no idea, Tom, how sensitive this market will be to incoming economic data, given how much we don't know about this variant. Do we respond more to a softer print than an explosive, really, really strong jobs print this Friday? I'm not sure, Tom.
By the time we get to Friday, and frankly, even to tomorrow, are we going to see first cases, as Dr. Fauci talks about, in America of Omicron?
Yeah, and should we respond to that? I don't think we should. Tom, let's be clear about this. Most people believe it's already here. What matters is not if we have a couple of cases in America. We're going to have those headlines. We will. Those headlines will drop. A case found here, a case found there. What we need to know, is it more contagious? Is it more severe? And does it escape vaccine protection? They're the questions, the answers we need to find.
Here's the headline. This is off Morning Joe this morning. And for our international audience, there's many cross purposes in messaging within U.S. Health, CDC, and the rest of it. This is from the National Institute of Health's Collins, the leadership at NIH. Omicron, probably highly contagious. And as a science, John, I see two adverbs there, and that's always not good.
Probably.
When you see two adverbs, probably, highly, that's as unspecific as you can get.
And then, Tom, even if that is the conclusion, then you've got to work out how severe it is. To do that, it's going to take a number of weeks.
Highly.
Then from there, you've got to work out, does it escape vaccine protection? And ultimately, because it's more contagious, does not necessarily mean it's worse. If it's less severe, if the symptoms associated with it, Tom, are less severe, then that's approaching what a lot of people have been looking for a while, which is the endgame type stuff of something that is more contagious, but ultimately less severe, Tom. And we can work with that.
John, this is important. I mean, where would we use that? We will probably in a highly talk soccer.
And isn't that the issue, Tom? They can't give you any conclusions because there isn't enough data to draw any conclusions right now. So for all the hyperbole that you've seen in the media over the weekend, I think it's tremendously unhelpful. I'm going to repeat a sentence we've said all morning. We've taken some criticism for it. We don't know. Why can't people just say we don't know?
That's it.
We don't know.
Probably highly we don't know.
Probably highly.
We don't know.
Is probably not very helpful at this point. Jennifer Lee, senior economist at BMO Capital Markets, is going to join us a little bit later, live on radio and TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A warning from the World Health Organization. It says a new Omicron variant could lead to surges of the coronavirus with severe consequences. The variant was first detected in South Africa. Scientists there said it appears to spread more easily. The WHO assessed Omicron's risk as extremely high. Airlines, passengers and businesses had to respond to a deluge of travel restrictions announced over the weekend. There was an initial spate of flight bans from southern Africa. That has given way to wider-ranging measures that will make travel more expensive and less convenient. OPEC and its allies will discuss the impact of the Omicron variant at their meeting this week. That's according to Russia's Deputy Prime Minister. It's another sign that the OPEC Plus coalition may reconsider its planned production increase in January. And in Sweden, the parliament has once again voted to make Magdalena Andersson Prime Minister. Andersson will form a one-party government after narrowly winning the vote. Last Wednesday, Andersson became Sweden's first female Prime Minister. She resigned the same day when her junior partner in the government quit, following a defeat over the budget. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
What do you think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one-directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
There's a really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think it's time for change in policy at the Fed. And I was of the view that this may be easier with someone who hasn't repeated over and over again that inflation is transitory, don't worry about it, it's going away. Inflation is not transitory. And it's really important for the Fed to realize this.
Mohamed Al-Arian speaking over the weekend to Fox News Sunday. Always great to hear from Mohamed. Hopefully hear from him a little bit later this week on Bloomberg as well. From New York City on Bloomberg TV and radio, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro, together this morning with Kelly Lyons. Elisa back with us a little bit later this week. And here's the price action for you, shaping up as follows as we kick off a brand new trading week. Your equity market has a lift. It tilts higher by 36 on the S&P, up by 0.8%. Yields are higher too by 7 basis points to 154.66. Euro dollar's negative, the dollar making a comeback against the single currency. And crude TK, there's the move for you, up by $3 and about 40 cents, up by 5%.
Crude, of course, $76 on Brent crude, up $3.25. Of course, a JP Morgan note this morning off their London desk, a bit of a shock. One thing we will do, John and I and Kaylee will probably and highly look at the data this week. We have the right guest for that. Jennifer Lee joins, senior economist at BMO Capital Markets, who probably and highly always looks at the economic data. What matters this week, Jennifer?
Oh, good morning, everyone. You know, of course, it's going to be all about the jobs data. That's always the highlight almost every single month. But you know what? I'm going to point to the ISM surveys as two surveys I think are going to be far more interesting than payrolls, because that's where you get all those little comments and an inside look basically at what purchasing managers are facing these days. So this is like on the ground news. And we know that these supply chain problems, they can't last forever. And I think these two surveys are probably going to be the first place that you can probably glean that things are hopefully getting a little bit easier. I was hoping to see that last month, but we didn't see it. So we'll see what the respondents are saying for November. But it was interesting, though, I will say that last month I noticed that a couple of them were mentioning some workarounds, like because you don't have X, well, then we'll take Y. Right. So I noticed that comment in like the education sector and in wholesale. So people are trying to, people are adapting, or businesses are adapting, and they're figuring out ways to get around these supply chain issues.
If the economy is humming into year end, and certainly that's the reports we've received, can you gauge what the first quarter of next year looks like?
So right now we have a 3.5% annualized gain for the first quarter. And this will be a little bit slower than what we're probably going to see for the fourth quarter. But again, it's all within the trend. It will still be about 4% above year-ago levels. So the gains will continue, and this is as we see some easing, I guess, of the supply pressures as the year begins.
Do these forecasts, Jennifer, now have a huge asterisk next to them until we find out a little bit more about this new variant that we're obsessing over the last week or so, the last few days?
Oh, everything I think has an asterisk around it, but I think there's even the weekend. I will admit that I was even trying to figure out how to pronounce it. But I think we have to figure out still. There's so many unknowns about this new variant. Just trying to determine how serious it is. And yes, we know that it's easily transmissible, but are we going to be back to packed ICUs? Let's hope not. And so I think that's the big question mark. And as well, this is the big difference from last time around. Like last year, is that we've got around 70% roughly of the population vaccinated, and that's the huge difference. Now, whether or not it will be effective against this particular variant, we will see. But it definitely helps bar some of those effects, I would think.
We've got to wait to find out. And the reason I asked that, Jennifer, is you tee up the ISM. Typically, I would too. I'd say the ISM, then on to payrolls, a really important week for economic data. For many market participants right now, I wonder how sensitive they'll be to that incoming data, given the conversation we're having more broadly about COVID. Jen, when you speak to people in the market right now, how receptive are they to this message that you should focus on the ISMs this week, because they're focusing on something else?
I still think we have to focus in on the data. A lot of this, again, is just fear, especially with COVID, and everyone it's understandable why we would be fearful of something. This is of a big unknown. But I think the data still matter, especially for the Federal Reserve. And as we see, price pressure is rising continuously. We're going to expect some sort of a rate hike in probably in the third quarter of 2022.
Well, Jennifer, speaking of fear and price pressures, we've seen consumer confidence waning at the same time that you're not seeing it translate into consumer spending or consumption. They are still out in the economy. They are buying. They're maybe using those stored up savings in order to make purchases of items that are more expensive than they were, say, 6 months ago. When do you expect the consumer to start feeling these inflationary forces more?
I think they are already facing it, and that's why we're seeing some wavering, I guess, on the consumer confidence front. But at the end of the day, I mean, it also depends on, I hate to say it, but the time of day and what day of the week that they're being asked this question. But at the end of the day, it's all about savings and incomes, and we saw from last week a very solid increase in wages and salaries, which at the end of the day, that's really what matters. And having a nice little nest egg put aside for a rainy day, and I'm sure we're going to have quite a few of those in the coming months. So I think that at the end of the day is just what matters most for consumer confidence. And of course, everyone is not happy about all these increases in prices, but as long as they have the incomes to afford it, I think that's the bottom line of that.
What do you expect we'll see from the wage data specifically on Friday?
So we are looking for an increase of about 0.4 on earnings, about 5% year over year. So that's basically in line with the average of the last 7 months or so. Again, steady increases to help pad everyone's wallets and savings accounts, because the labor market remains very, very tight. And who knows what's going to happen with this new variant? If it's going to put pressure on people to perhaps not go back to the workforce as quickly as they were thinking about. So then you're going to see higher wages coming from the businesses to help entice them over.
Jennifer Lee, always good to hear from you. Thanks for being with us. Jennifer Lee there of BMO on the data for the week ahead. The ISM's coming on Wednesday, and then on to Friday. It's payrolls Friday. This jobs market through the whole of this year has been incredibly, incredibly unpredictable. We've talked about the wide range of estimates every single month when we get the payrolls report. Tom, just a 425,000 spread now. 800K at the high end.
Just.
The low end, 375K. I say just. The median, 535. But Tom, come on. 800 at the high end, 375 at the low end. We've got no clarity on this labor market.
To me, it's two Americas. Maybe the president will address it today, as he has in recent comments, and that you've got a fully employed, bang-up, humming economy, and you've got a whole other group of Americans just simply not participating. What I find in the pandemic and before the pandemic is accentuated inequalities there.
I've got a ton of respect, Tom, for the economists on the street. You know that. So many of them are good friends of ours in this program. We're still throwing darts, aren't we? When we hear from BMO and they say we've got a tight labour market, I can find someone just as educated, just as sharp, with just as much experience on Wall Street saying completely the opposite thing.
That makes the argument. But
we're so divided still.
I'm going to go back to the technology overlay here. There's a whole group that is, the Amazon and Target and all the rest of them booming, those warehouses booming, and just fully employed America. You can't get labor. And then, oops, you can't.
Still trying to work it out. Yeah. Kaylee, 800 at the high end, 375 at the low end.
Forecasting has been impossible in the pandemic economy, and that remains true. It's been true for some time, and it's true consistently every single jobs report we've gotten for what seems like months and months now, John.
Remember that when we get the new economic forecast from the Federal Reserve on December 15th. What are those forecasts worth in an environment like this one?
The dots are so valuable.
The dots are coming up.
The dots.
You're excited about the dots? The dots a few weeks away from New York. This is Bloomberg.
perfect.
In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Leanie Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Sydney. In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this story. How are you thinking about those dynamics?
It's a turnaround Monday, a little one, an unconvincing one for some of you. Here's the price action, starting with your equity market. Equity futures bouncing back. On Friday, the biggest one-day loss going back to February of this year. This Monday morning, up 0.8% on 10-year yields. We were down 16 basis points on Friday. This morning, we're up 7. On Tuesday, we were down 15 basis points. At the front end, a real repricing, and then a little bit of a bounce again on a 2-year yield. This morning, if you take a look at crude, WTI was down about 13%. On Friday, this morning, it's up by 5.3%, 71.75. Just an idea, Tom, of the turnaround we're having this morning in the context of the drawdown that we saw on Friday. A lot of people looking at this and saying, I'm not so convinced.
Yeah, and it's correlated turnaround. Everything's sort of linked together here. We don't need to spend a lot of time on this, but it's there. And again, I'm watching the VIX just as a single litmus paper, 24.77 where it was 3 hours ago. It got worse in the last 2 hours. It's come back a little bit of enthusiasm.
Do you want to bring up Hertz quickly? $2 billion share buyback program.
We got to be careful.
Stocks up in
here.
a pre-market.
I want to be careful here and just stay with facts. This is an IPO of November 8, 98% debt. It's it was even 1.2% equity at weight. All of a sudden, they come out with a share buyback. It came out at 29 down to 23, and they announced a buyback today, and they're doing this with a fiction of a financial statement. It'll be interesting to see. I don't have any strong belief here, John, other than it's odd.
You're comfortable using the F word, fiction?
I'm sorry. I'm just looking at the Bloomberg. Okay. EBITDA. They got some generation of EBITDA. I'll give them that. But they got massive CapEx going on. You get cash from operations, not that much, and I got free cash flow, which I guess is going to flip in the next 12 months.
$2 billion buyback, Tom. Stocks up in a pre-market 8.7%.
Surging.
Is that a surge?
It's a surge as well.
It's a surge of almost 9%.
Let's get back to the market, and I want to look now at the summation of equity markets and then off the bid and ask. Michael O'Rourke is very good at that, moving maybe from the theory and 60,000 feet down to actually, what do you do now? He is chief what do you do now strategist at Jones Trading, and we're thrilled Michael O'Rourke could join us this morning. Michael, I look at all of this, and it's simple. Forget buy the dip, it's buy the fear, and you say buy the fear.
Well, I say fade the fear, I guess, is the best way to describe it, because I'm still questionable about the equity market here. We saw some notable weakness last week where on Monday we hit all-time highs for the S&P 500, but simultaneously we had 1,000 new lows on U.S. exchanges, and then we had another 1,000 new lows on Tuesday. So I do wonder if some of Friday's action was actually just this latent weakness in the U.S. equity market or a tired bull market. Whereas on the flip side, a lot of these other moves, like you guys mentioned, energy, bonds, those are all moves that I would take the other side of Friday's action. So another group that was weak on Friday was that value space, which in favor of growth. And again, I'd buy that value space and sell that growth space. So with the exception of the S&P 500 itself, I would take the other side in Friday's action.
Was it a correction on Friday? Can you have a one-day correction?
Well, that's the problem, and that's exactly what I think is the issue here. You're talking about making new all-time highs on Monday. We have a 2.5% sell-off on Friday. It's going to take more time than that. The closest incident we've ever had to that, with such a level of new lows reached and being so close to new all-time highs, was back in December of 2014. And for the next 3 to 6 months, we saw a lot of volatility with the equity markets without the S&P 500 making much meaningful progress.
John, it was a correction of 2.31%.
A 2.31% correction. And still close to all-time highs.
Crushed.
Not far off them anyway. Mike, you picked up on something I think is important. What does it say about market conditions when we can switch so easily from one extreme to another, almost instantaneously? We've gone from inflation's too high, the Fed needs to go quicker, to we're facing a lockdown. That's what people were talking about on Friday. Just one extreme to another, just like that.
I think it's a lack of confidence. I think people are unsure what's going to play out in 2022. And that's for good reason, because we are looking at a change of regime. We're looking at a Fed that's facing real inflation for the first time in 20 years. It's probably more like 30 years, sorry. So for the past 13 years, every time we had a dip in the markets, the Fed could always step in and support them, and they had this luxury of a benign inflation environment. That environment doesn't exist now.
Yeah.
So it brings a lot of caution and a tentative nature to the market. That I think that's why we're seeing that underlying weakness in equities. You don't see it because the big six NASDAQ, momentum mega cap names support the index. But beyond that, you're seeing weakness elsewhere. And I think you're also going to see
this morning on this program brought it up as well. With this backdrop, the Fed put is less durable. And with that in mind, should we get used to more episodes like what we saw on Friday? And was that just about a mutation, a variant that got on everyone's radar? Or more broadly, does it tell you something about the market conditions we're likely to experience over the next several months?
I think it's the latter. I think there's going to be a little more volatility. The path isn't quite so clear. The Fed does have its hands tied. Obviously, they've stuck to the transitory argument all year. Nobody in the market believes that. So again, any step back from the current policy path is really going to be scrutinized, and I think they're going to have a challenge there. So for the time being, and Chairman Powell says it repeatedly himself, although he hasn't acted on it, that the Fed's not supposed to react to movements in the stock market. So obviously we'll see him on Capitol Hill tomorrow, Wednesday. We'll see how he talks about inflation and things like that. But it's definitely a different environment than the one we've experienced for the past 2 years now, and the 10 years before that. So we should see how 2022 plays out, but it should have a little more volatility.
Does that mean it's time to start buying protection, Mike?
Well, when volatility is low, it's generally a good time to buy protection, especially with the combination of prices being high. So I've been on the more defensive side of the tape to begin with. I've been pushing the value trade. I think value is as attractive versus growth as it's been in probably ever. But we're testing the lows we made last year, which were in the fall. So I think that's one way to play it is, I've talked about the financials. I really like the banks here. I like them for the recovery. I like them for the rising rate environment. You look at a group like energy, the energy policy in this country is now shifted to, we don't want to drill here. So the guys who are drilling here are going to benefit from that because they're going to have a competitive advantage and there's going to be less supply out there. So I think it's these structural shifts out there that you have to identify in the market, and that's what you want to play. But more broadly speaking, the major indexes are driven by these mega caps that have had incredible runs, and you might want protection against any type of weakness or consolidation among them.
Well, wouldn't that mean weakness or consolidation for the broader market, given how much weight they pull?
100%. That's exactly it, and that is why you want protection for the broad tape, because those big names drive the major indices.
My final question is the Christmas tree up at the O'Rourke household.
It's not up, but we picked it up yesterday.
You picked it up. Was it fake or real, Mike? Which one was it?
It's real. It's real. But we had to do it when my son was home from school.
Tom Keane, proud. Are you proud of that?
I'm proud of that, but the real issue, John, is you have to understand you have white cutesy pie lights like you have. Little perfect little white lights.
Well, what lights have you got?
You have to have ugly, big, ugly colored lights where a number of them are out. And so you move the
That's tradition.
You've always got too many.
That's what I had as a kid.
This is traumatic. You always have too many orange lights and not enough
We
white
had the multicolored
bulbs.
ones.
The bulbs, yeah.
And then they'd go out and you'd have to replace them.
Yeah, I used to plug it in. Back when we were rich, I had a 14-foot tree. I'd plug it in and Staten Island would dim. But, it's changed now.
What are you going with? You've got the multicolored
No,
lights
we're going
ready,
with a smaller tree this year because kennel fee is just out of control.
Mike, thank you, sir. It's good to hear from you. Mike O'Rourke there.
Michael's like, what am I doing? Why
Well, it's, it's an important moment, Tom. We need to talk about that. Coming up on the Open, Greg Peters, PGIM Fixed Income Co-CIO. We'll catch up with Greg a little bit later.
Kaylee's tree is all orange lights. Oh, how cute.
Is that what she said? Have you got the lights up?
I do.
University
See,
they're all one
you
color.
all had a go at me a couple of weeks ago for getting this tree up, and now there's a scramble.
Scramble?
And now there's a
I
scramble.
don't think I'm going to. I'm going to take a cactus and move it over and say, this is it.
There's a monster scramble to get the tree up now. Just like that.
Where are you going?
I'm not going. They played the music. I was going to leave, but then I looked at the clock and they played the music too early.
They did.
Guess what we've got? Guess what we've got? You've got a minute and 40 seconds to burn.
So at 9 a.m., you're going to drive forward the story. And seriously, it goes out to the president at 11:40.
No, we've got to talk about credit with Greg Peters.
Yeah.
There's more going on here than just the obsession over the variant.
I agree.
I think it's important to
Totally
talk about the variant. I think it's important to work out the questions. We need to have answers. It's important to recognize we don't have the answers to those questions.
Yeah.
Is it more contagious? Is it more severe? Does it stand up to the vaccine? It's going to take a couple of weeks to find that out. But what we saw in credit and the issues around it were a continuation of the story through much of the last month, Tom. There's a worry about this Fed needing to pull back a bit more quickly.
You sold Peters out to 9 o'clock. Can I sell Peter Hotez coming up?
Absolutely,
right
and you should do.
Peter Hotez, folks, is one of the most original guys. He had the privilege of being at Rockefeller University in the absolute ferment of the invention of mRNA and all of that theoretical virology stuff, John. And he's just such an authority, and I'm going to grill him hard on this.
And we've got to work out, Tom, the right sources to go to over the next couple of weeks. When you hear from the vaccine providers say things like, it looks like we're going to need to change things up to address this particular mutation.
We don't know.
There's the correct degree of skepticism around the message that would come from the vaccine providers who quite clearly, Tom, have got some skin in the game.
Well, yeah, the providers is one thing, but here's the thing. We got 59%, and the president's going to come out, John, and he's going to say, what does it take to get to 69% total vaccination? Maybe this is the event that does it.
You can play the music now. We go.
And cue.
Tom Keane.
I get a royalty
Farrow.
check every time they play that music, John. I don't know if you know.
Kelly Lines. Did you design this music?
No, I did not design the music.
I was going to say, is this your fault?
No.
No? From New York. This is Bloomberg.
With the first word news, I'm Rich Kigup. The World Health Organization warns that the new Omicron variant could fuel coronavirus surges with severe consequences. The agency calls the variant's risk extremely high. Omicron was first detected in South Africa. Scientists there said it appears to spread more easily. A number of nations have now imposed travel restrictions to try to contain the variant's transmission. Moderna says it could have a new vaccine ready to fight the Omicron variant by early next year if required. That has the company's shares rising. Meanwhile, BioNTech is trying to adapt its COVID vaccine to handle Omicron. The German BioNTech and its vaccine partner Pfizer put plans into place months ago to ensure a new version of their shot could ship within 100 days. President Biden meets today with CEOs of companies from a variety of sectors. He'll discuss supply chain bottlenecks and the administration's efforts to combat inflation. Chief executives from Best Buy, Mattel, Kroger, and Samsung are amongst those expected to attend in person. The CEOs of Walmart and CVS will attend virtually. And shares of Hertz are rising today pre-market. The car rental companies announced a $2 billion stock buyback program. Hertz went public earlier this month after emerging from Chapter 11 bankruptcy protection. The company has thousands of locations under the Hertz, Dollar, and Thrifty brands. And the most high-profile black figure in luxury fashion has died. LVMH's star designer Virgil Abloh has battled cancer for several years. He was 41. He was known for his influence on streetwear and sneaker culture and for his success in revitalizing Louis Vuitton. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go.
Okay, guys, back to Bitcoin. As you can see, position opened on Bitcoin at 57,506. Okay, how it works with Bitcoin? We place stop on our profit when it will reach 1.5%. We will see how far it will go in our favor. Okay, guys, so it doesn't work like with pairs, euro or Japanese yen, when we place stop on profit for based on pips. With Bitcoin, because it's kind of widespread, also based on buy and sell offers, we cannot do this. So if it will reach certain percentage, like 0.5%, we will see what we're going to do with this. Okay, guys? If you want to get a strategy, please go to company.co.uk and you can get the strategy. Also, place is still available for our webinar. So don't miss your spot. You can register for your webinar. Stay safe, guys. I'll speak to you later.
Days, obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks to get it back to the sort of more normal running levels.
particular variant has a number of concerning mutations that resemble some of the other variants that we had. None of those variants totally escaped the vaccine. None of them were like our worst nightmare come true. And we have to go through the process of studying this variant while we continue to be vigilant.
Professor Sharfstein, Joshua Sharfstein, Vice Dean at Johns Hopkins, there on the domestic story of Omicron and all that we've heard about since Friday. The shock of a variant. Well, we knew there were variants there, but the mystery, I should say, of this variant. Right now, Kaylee Lyons and I, with our conversation of the day, and it's with the gentleman, Peter Hotez, the Dean of the National School of Tropical Medicine at Baylor College, but far more than that, someone who has fought the virology and virus wars and the parasitology wars for decades. The difference is Peter Hotez understands the tropical medicine of Africa, the challenges of the geography of Southern Africa that we don't understand. Peter, to me, that's so much the mystery here is how ignorant we are about what needs to be done in Southern Africa. We don't understand it's larger than America on a geographic basis.
Yeah, you're absolutely right. If you actually were to superimpose a map of the United States and the African continent, it would barely register. I mean, the African continent is vast geographically. And unfortunately, the one lesson we've learned about the worst variants that we have is they arise out of large unvaccinated populations. The Alpha variant arose out of an unvaccinated population in the UK in 2020, Delta out of an unvaccinated population in India in 2021. What did people think was going to happen, allowing Africa, the African continent, to go completely unvaccinated?
This is not hookworm, and you've been leading on this for decades. You did your PhD thesis at Rockefeller on the horrific tropical diseases, the parasites, and all that. If you know the terrain, what holds the rich guys back from helping the poor guys? Is it an economic constraint, a financial constraint, or is it a moral constraint?
It was, the way I see it, Tom, was a science policy failure. The G7 countries were so fixed when this virus hit on speed and innovation that they all ran like a little kid's soccer game where the ball goes in one direction. It was all about mRNA technology and new and exciting, what I sometimes say in my frustration, shiny new toys that no one ever gave thought, as any, first-year engineering student will tell you, that when you rely exclusively on a brand new technology, there's a learning curve before you can go from 0 to 9 billion doses, or 9 billion of anything, whether it's widgets or mRNA vaccines. If it's a brand new technology, there's a learning curve. And so there was never the situational awareness among the G7 leaders to say, hey, wait a minute, we also need to balance the portfolio with an older technology that we know we could scale in places like India and Bangladesh and Indonesia and on the African continent. And that's what we did. So we've developed this recombinant protein vaccine. It's been licensed with no patents, no strings attached, to vaccine developers in India, Indonesia, Bangladesh, and now with a developer linked to sub-Saharan Africa. And we're doing it, and we're making it. But if we had even a fraction of the help that Moderna or Pfizer had gotten from the G7 countries, we might have had the world vaccinated by now.
Peter, you talked about policy failures. Is just imposing travel bans from Southern Africa a policy failure?
I think it is. We've learned that travel bans simply don't work. We learned this from the beginning, right? We remember how in February of 2020, everybody was so focused on travel bans from China. Meanwhile, the virus had already entered into New York City from Southern Europe to ignite that horrific epidemic across New York City. So we know that this virus is already spread around the world, and that's not because there's anything unique to Omicron. That's been true of every variant that we've seen so far. By the time we identify a variant, it's already gone global, and so I think a lot of this is based on optics, where especially in the European Union and now the U.S., they want to show that they're doing something, and unfortunately, it's incredibly self-defeating. It actually impairs our ability to fight the pandemic, number one, and number two, it punishes African countries, and number three, it hurts the economy because it spreads unnecessary panic among investors, and so it's a policy failure on all accounts.
Well, we did see that panic in the markets taking shape on Friday. This Monday morning, we are getting a bit of a lift to them now as people really understand that we have very little information at this point. What information is most critical to ascertain first?
There's three things we need to know. One, about the severity of the illness, and so far it does not look like this variant is producing anything unusual in terms of symptoms or severity of illness, but we'll know more. Second, we need to know if the vaccines, our current vaccines, will cross-protect against the Omicron variant. That's what we're doing in our laboratories this week with our vaccine, as is, I'm sure, Pfizer and Moderna. And the way you do that is you look at antibody responses to your vaccines and show that it neutralizes the Omicron variant or what's called a pseudovirus variant, and we'll know that in the coming days. I think there's a good possibility that with the third immunizations and that boost, that you'll get enough virus neutralizing antibodies to cross-protect at least partially. I don't know that for certain, but that's the hope. And then we really need to understand the transmissibility. We don't know that.
Peter, one final question. I really looked at the vaccination trends this morning, and I think what we're going to hear from the president is we need to get from 59% vaccinated to 69% vaccinated. How quickly is that doable?
Well, 69% unfortunately won't cut it. We need 85% of the U.S. population vaccinated. And, Tom, we've got this horrific situation in the United States where since June 1, 2021, 150,000 Americans who refused vaccinations needlessly perished from COVID-19. 150,000. So anti-science defiance and aggression is now a leading killer of young Americans in the United States. And as long as we have that defiance, it's going to be hard to see how we get to that 85% level.
And Peter Hotez, thank you for joining us, particularly your perspective on Southern Africa. He's with Baylor College as well. Kaylee, a lift to the market. I've sort of been waiting for this morning, and that we get a little bit of an authority. Dow futures up 240 have become Dow futures up 360, SPX futures up 50 as well. And Kaylee, the VIX comes in.
Yeah, and it seems like the move may have been led by oil, Tom. WTI now up better part of 7%, about 6.6% right now. We're back to 72.67 a barrel. So right now we're at about half of Friday's loss is being gained back, and that is true too when you look at equity futures. So maybe the bounce is becoming a little bit more convincing. There's a little bit more gusto as we approach the opening bell.
And please stay with us on Bloomberg Radio and Bloomberg Television through this morning as we work towards the president's address to the nation. I believe, again, 11:45 is the schedule for that. Back rested from Nantucket, I presume. We've got lots more coming up, good conversations on economics, finance, investment, and yes, highly and probably virology. Coming up, the chairman and chief executive officer of Pfizer. This is Bloomberg. Good morning.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter 3 was the quarter that was most affected.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Looking for a bounce back this Monday morning from New York City for our audience worldwide. Good morning, good morning. Your equity market up a little more than 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. The Fed stuck between a rock and a hard place.
There's still an awful lot we don't know about the Omicron variant.
What we do know doesn't necessarily derail things.
A particularly sinister, pernicious variant would be a huge threat.
The scenario now that the Fed has got to taper right away, that the Fed will be raising rates by June or July, I think that scenario is a little less likely.
Yes, I think there is some risk that some of the market-implied hikes will need to come out.
I think investors are just going to count to 10 before moving again.
We are reminded that, if you will, policymakers are more fragile in the direction of growth.
Let's get this week's conversation started with PGIM's Greg Peters, JP Morgan's Jack Caffrey, and Emily Hill of Bowersock Capital Partners. Emily, I want to begin with you and just a comment on how quickly we've transitioned from one extreme to another. Inflation's really hot, the Fed has to go quicker, then all of a sudden the worry about another lockdown in Europe, in the US, around the rest of the world as well. Can you comment on that, just the market conditions that have switched so easily from one extreme to another?
Well, for one thing, the news was announced right before Black Friday, which has, regularly has very low volumes. So I think it's difficult to draw a conclusion from the plunge in the markets on Friday. I think what's surprising is that there has not, that another variant hasn't emerged sooner. So I think it's important not to draw drastic conclusions from market movements, on one of the lower volume trading days of the year.
Greg, it is so difficult to draw conclusions, even if it wasn't on the lowest volume trading day of the year. We don't know how contagious this new variant is. We don't know how severe it is. And we don't know if vaccines stand up to it. It's going to be a couple of weeks, Greg, before we can draw any conclusions. What do you do in between?
I think you just buckle down, honestly. This should not be a surprise to anyone. I mean, we're operating in this kind of existential world controlled by this COVID mutation. So, to me, this is not a surprise. I think it's a complicating factor. I think it's okay to say what you know and what you don't know. So to me, I think it's a a volatility event, and it continues to keep the market on knife's edge for a little bit.
Jack, we've got little choice but just to say we don't know, and we don't know a lot.
You know, I think a little humility is appropriate, but at the same time, for a year and a half now, this has been a series of financial markets that have remained very sensitive to any news that we were seeing a worsening of virus-related conditions. And we entered this with a pretty reasonable degree of high expectations across financial markets. And so that you could add low liquidity from Black Friday, that we still have so much we don't know. But over the next 2 weeks, we are going to get data. We're going to find out how the consumer responded to cyber sales and to Black Friday. And over the next few days, we're going to get more economic data. And ultimately, we wind up with more data through the course of the week to actually suggest, is the broad trend of the economy still positive or not? And then maybe we'll get some medical data to tell us whether we need to readjust those assessments.
ISM data on Wednesday, payrolls on Friday. We need to talk about how receptive, how sensitive this market will be to those data points. Given we don't know at this point, given the backdrop, what it will mean for monetary policy. This came from Citi. They say if increased travel and lockdown measures look likely over the next several weeks, then this may have significant implications for the sequence of central bank meetings coming up in the middle of December. It's likely the path of the pandemic will override all other considerations for central bankers in the short term. Emily, does this resonate with you? We've been teeing up this big Fed meeting in the middle of December. I wonder how big that still is.
I do think the emergence of this new variant makes stagflation a little bit more of a risk. And so I think that it may, I mean, if you look what the market is pricing in terms of the 10-year, or in terms of Fed rate hikes, I should say, you know, it dropped from expecting about 3 hikes in 2022 down to 2. And I think part of that is that the Fed, you know, the Fed's in a little bit more of a jam even than they were in before. So I do think this reduces the likelihood of increasing the velocity of the taper, which I think would have been a possibility, you know, I probably would have expected that if you'd asked me a week ago.
Well, they've been teeing that up over the last several weeks for sure. We heard from Governor Waller, we heard from Vice Chair Clarida, Presidents Daly and Bostic as well. The Atlanta Fed president had this to say on Friday on Fox. Take a listen.
I'm very open to accelerating the pace of our slowdown in purchases, mainly so that we're ready and we have that optionality. For me, early second quarter, late first quarter of 2022 are all in play as reasonable alternatives for when we might stop our purchases if the economy's momentum continues how it has over the last several months.
Greg Peters, given what we don't know, is this still in play?
I think so. I think it's clear that central bankers want to remove accommodation, right? So this is a complicating factor, but I think what they're most focused on actually is not the virus itself, but inflation. I think there's intense political pressure around the inflation front. I think they're focused on that as a result. They completely abandoned this fiat regime. So to me, it's still very much in play. Yes, it's a complicating factor. Should they include it in the assessment? Absolutely. Will they? Probably not.
How durable is the Fed put then, Greg, in your mind? I've been asking that question through the morning. Given the backdrop that you describe, how durable is a Fed put in that backdrop?
I don't think it's very durable at all, right? So I think it's a very different environment, right? So you're not going to have the same ability to have central bank thrust. You're not going to have the fiscal thrust. So if in fact this is a worse situation than, let's say, you know, initially believed, then there's not a lot of wiggle room, both on the central bank side and on the fiscal side. And I think that matters. So, you know, I'm not convinced that there is this quote unquote put, at least one that's not struck close to the market levels.
So Peter Chair agrees with you of Academy Securities. This is what he had to say over the weekend coming into this trading week. We faced a sell-off where it's unclear what the Fed will do. There's no guarantee of easy money going forward. For now, the path seems to be fewer bond purchases and even rate hikes across the globe, which changes the buy the dip functionality. Jack, can I get your reaction to that? The buy the dip psychology of this market that has persisted for so long now. Are we questioning that?
I don't think we question buy the dip yet, because I think this is a Fed that's going to remain on the reactive side rather than responsive. And just to the extent that they want more data and they consistently want and say they'll be guided by the data, they just got a boost, if you will, of data that was very uncertain relative to the plans that they were talking about. I don't think anything I've heard would suggest that they need to respond faster. I would have thought that we've moved away from lockdowns, and then just middle of last week, you began hearing more about lockdowns in certain core European markets. And so I would look to, I think the Fed remains reactive. I think they're going to find now reason to be a little bit slower to move. But I think that the challenge from that could be slower now means faster later. And that will be yet another round for us to worry about. And I come back to, if we look at the MOVE index, the implied volatility in the Treasury market on a curve-weighted basis, fixed income markets would be suggesting they don't really know where the Fed might be going anyway, based on sort of the real recognition that implied fixed income volatility remains exceptionally high, much more so than equity volatility.
Got a 15 basis point move on Friday. Yields lower this morning, higher by 4 basis points. On 2s up to about 53, on 10s up by 8 to 155. Emily, when I asked that question to Greg and Jack, they have different opinions on it. Can I get yours?
On the 10-year?
Not on the 10-year, specifically on how durable this Fed put is with this backdrop.
Okay. Well, I frankly don't think that I don't think the buy the dip is over. I think that the retail trading factor is very significant, and I think all of the liquidity in the market will be a real cushion to future volatility. With regard to the Fed, I think I actually agree with them that inflation is transitory. It depends on your definition of what transitory is, but I don't expect this really to affect their long-term approach. I believe I answered your question.
Just about. You did. Don't worry about that. Comment on this, Greg. That's the equity view. Give me the credit view. Spreads going back towards the wides of the year. 340 looking at Bloomberg high-yield credit spreads right now. Certainly not as wide as they might be, given historical measures, but still. Looking at that move, Greg, how do you respond to it? What would you do?
Yeah, so I do think it's steady as she goes. What I do think is an important point to make, though, around what Fed reaction means. So Fed reaction today means not tightening, whereas before it was easing. And I think that matters a lot. And I think that the credit markets are somewhat responding to that. And so you have seen credit spreads widen from the tights that we saw, post-cycle, actually. So, I think it's going to be an environment where it's going to be volatile. Spreads are going to remain a little wider. I think the tendency will be kind of to bounce around these levels. I don't see a lot of tightening going forward. So it's basically this classic roll and carry type of environment because defaults are low and credit fundamentals are still quite good.
Greg, how active were you on Friday? Can you just walk me through market conditions, what they were like in Friday's very short trading session?
Well, I don't think it was very active at all. I mean, I think a lot of professional investors were taking the day off or trying to take the day off on Friday. I do think that exacerbated the price action, to be brutally frank. I know we like to discount that, but the truth is liquidity was very thin. So it's hard to get a true read on the reaction. So I think that was kind of the playbook for most professional investors, where Friday was just watched and didn't really react. So I think this week we'll get a better sense of the market reaction to the data, not only economic data, but the virus data as well.
We're going to talk about that in just a moment. Greg Peters, Emily Hill, Jack Caffrey sticking with us. Coming up, markets on edge with the Omicron variant taking center stage.
Sort of throws a lot of uncertainty into the mix. We were looking, I think, on track for a pretty good recovery or continued strong growth going into next year. This raises a question mark about that.
A big week of economic data coming right up. That conversation is next. This is Bloomberg.
is an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I talked to the Fed about a whole range of things, from monetary policy to inflation. And I have confidence that the appointees that I've made and have, excuse me, 3 more are going to reflect that concern.
Investors facing another big week for the markets, concluding with the payrolls report this Friday. The team at Deutsche Bank saying the following: the economic calendar is packed with important data, as well as Fed speak that will shape market expectations going into the December 15th FOMC meeting. For more on the week ahead, here's Abby.
Well, John, it is certainly going to be a big one for both the Fed and economic data, as you were just mentioning, starting with the former. Of course, Fed Chair Jay Powell today speaking at a Fed New York Innovation event. Then tomorrow and Wednesday speaking with Secretary of Treasury Janet Yellen before Congress, testifying on the CARES Relief Act. The big question is, will they mention the new COVID variant? In addition, Williams, Bostic, Quarles, and several others will be speaking this week. What will be the Omicron effect, if anything? One thing we do know, markets at this point, as Emily Hill had mentioned, pricing in a slower overall pace of hikes for 2022 now, just 2 hikes as opposed to 3, 4 overall by December of 2023. Data-wise, ISM manufacturing out on Thursday, the survey looking for a reading of 61. That's big-time expansion. Of anything above 50 is expansion. And then payrolls on Friday, 535,000 jobs expected to be added, about flat to October. Now, very interesting, John, is for OPEC Plus. They have delayed their meeting by a couple of days. Oil very volatile over the last couple of sessions, down about 7%, hitting long-term support. The question is, will those long-term buyers continue to support oil? It's going to be all down to the economic impact of this new variant, Omicron.
A focus on the economic data. Abby, have you seen the payrolls estimates for Friday? The range, 800K at the top end, down to 375 at the low end. 535 is the median estimate. That range is still so wide.
Very wide indeed, John, and it shows you just the degree of uncertainty relative to economists in terms of all of the different impacts on the economy that we're looking at right now relative to the virus. It'll be interesting to see whether it comes right in the middle. For the month of October, it was 531, just 4,000 now, the survey for November. Will it be that flat, or is it going to be somewhere toward the low or the high? We'll know Friday.
Abby, thank you. 800K, the estimate coming out of Jefferies. 800K the top end, 375 at the low end. We'll get to that in just a moment. The team at Goldman saying the following about calculating the impact of this new COVID variant. The upshot is that Omicron could have sizable growth effects, but that the range of medical and therefore economic outcomes remains unusually wide. Given this, we're not making Omicron-related changes to our growth, inflation, and monetary policy forecasts until the likelihood of these scenarios has become somewhat clearer. Still with us, Greg Peters, Jack Caffrey, Emily Hill. Greg, straight to you, sir. All the way from 375 at the low end to 800K at the high end. Why are we still finding this so difficult to get right, to forecast the economic data in America, to see a range that wide to end the year?
Oh, look, I think it's just emblematic of the uncertainty, and that just represents it. So to me, it's not surprising at all. I mean, I keep going back to this adage where it's clear as mud. I think it's really difficult to get a true handle on the underlying economy, both the labor market and inflation. So to me, this just represents the wide range of expectations and uncertainty. And I don't expect that to change. So once again, I think we're going to continue to operate in this environment where the data is unclear and we're really, in this uncertain world. And I think what complicates this factor is that the Fed and other central banks are trying to assess and make changes based on the lack of clarity.
And this is why it's so difficult. I'll go to that quote again, Emily Hill from Goldman. The range of medical and therefore economic outcomes remains unusually wide. Emily, wouldn't that be true with or without the news of the last week?
That would definitely be true. And one of the things that I keep telling my clients is that I think the best historical parallel for what we're seeing now is post-World War II. Essentially, we went through a war with the pandemic, and very similar to what happened when the troops were coming back from World War II, there was massive public debt. You had labor force dislocations trying to rematch returning troops into the labor force. You had significant supply chain shortages and temporary rising inflation. I think that's the kind of environment we're in now, where this pandemic was a cataclysm for the economy. So it's not surprising that there's a lot of uncertainty with regard to the jobs numbers. I would expect them to come in roughly flat, so in the middle of that range. But I agree with Greg that it's a very difficult call to make in these circumstances.
But ultimately, Emily, too early to worry about the 70s. Is that your message?
Yes, definitely. This is not the 1970s.
Jack, you'd agree?
We are not repeating the 1970s, but I think there are going to be some echoes from it. I do think that we certainly have a variety of central banks that are indicating a greater degree of comfort with higher inflation than we had talked about the idea of price stability. And I do think that we can look to a variety of decades and try to find something that rhymes. And since you haven't asked, but I'll try to go there anyway, I look at the employment number and I start wondering, when we start talking about labor shortages, actually starting to put a bit of an upside limit in terms of how much hiring activity we can actually experience. To what extent we have a labor mismatch between what people want versus what companies want, and what companies want to pay versus what labor might feel it wants to talk about. And so I think we're going to start spending more time thinking about the quit rate being as important in terms of the initial hiring rate, because to some extent we're going to start needing to see more quits to actually create more jobs on the other end.
Jack, isn't that moment right now? Aren't we there already?
I thought we were getting there very much, but at the same time now we have this new factor in terms of to what extent people might just choose to put the brakes on their plans. We will, I think, I'll come back to the data. I want the data to tell me what we're seeing and sort of to confirm what it is that everyone in the financial market believes is going to happen. For the last month and a half, last 2 months, the economic data has been better than we expected. And I think that's certainly been a very positive underpinning to where people start talking about earnings estimates and the idea of cash flows into next year.
We'll finish on the data. Greg Peters, I wonder how sensitive this market will be to incoming economic data this week, both the ISM on Wednesday and the payrolls report on Friday. Given what we've been talking about for the last 21 minutes, how sensitive do you think this market will be to incoming economic data?
I don't think the data really matters much this week, to be brutally honest. I think it's more around the rhetoric coming from Yellen and other Fed officials to see what their reaction function is to the virus and the mutation of the virus. So to me, I think the data takes a back seat this week. I think it's more around the rhetoric and then more around more clarity of the virus.
Greg, is it fair to say that a weaker print on Friday may mean more than a stronger print? A weaker print gives the Fed a reason maybe to wait and not do much. A stronger print, they just have to shrug off anyway.
Maybe, but it's also not inclusive of where we are today. So it is a lagging indicator. But yes, I think so. I think the Fed or the markets will look for any weaker data that allow them to back off. off. But who knows? I mean, they've been pretty focused on full steam ahead and actually quickening the pace. So it would be a big shift. But one thing we've learned over the past 6 months or so is that the Fed shifts and shifts often, and it does keep the markets on edge. So I do worry about that, honestly.
Greg Peters sticking with us with Emily Hill and Jack Caffrey. Bit of news on Twitter. CNBC reporting Jack Dorsey stepping down as the Twitter CEO. The stock market votes in the pre-market up by 11.5%. Call it almost 12 percentage points higher as CNBC reports Jack Dorsey is stepping down as the Twitter CEO. From New York, up next, the morning calls, and later, the reopening trade. Bouncing back from New York, this is Bloomberg.
Esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
About 5 minutes away from the opening bell, equities bouncing back by 1 full percentage point on the S&P 500 from Friday's drama. If you switch up the board, a bit of drama here for Twitter in the pre-market. The news out of CNBC that the Twitter CEO, Jack Dorsey, stepping down. The market can be brutal sometimes. The market voting, the market rallying, the stock up by a little more than 10%. That's the stock story. Here are your morning calls. First up, Citi downgrading Merck to neutral, opening a negative catalyst watch with the drug maker likely exiting its HIV program and treatment. Deutsche Bank downgrading UPS to a hold, seeing little remaining upside following the stock's massive outperformance recently. And finally, Jefferies raising its price target on Avis Budget to a street high 333. More than tripling his original target to reflect improving margins and strengthening pricing power. That stays up by a little more than 4%. Coming up, reopening trades rebounding, strategists preparing for a volatile month to close out the year. From New York, your cash open this Monday morning is next.
then 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
23 seconds away from the opening bell in New York City this Monday morning. Good morning to you all. Looking to bounce back from a brutal session for the equity bulls, at least on Friday. Equities pushing higher by about 50 points on the S&P, by a little more than 1%. On the Nasdaq, up by almost 200, advancing by about 1.2%. That's the opening bell. The trading week underway. Switch on the board and get to the bond market on Friday, down 15 basis points on a 10-year. This morning up 9 to 156.20. Euro dollar turning back around 112.70, negative 0.4% there. A bit of dollar strength back in play. And in the commodity market, a huge move lower in Friday's session, down by 10, 11, 12, 13 percentage points on WTI crude. This morning advancing 6.29% to 72.49. Two stocks to look at in the early part of the session, 25 seconds in. One is Twitter, the other is Square. Here's the early interpretation of a headline that dropped 15 minutes ago from CNBC that Jack Dorsey is looking to step down as the CEO of Twitter. Jack Dorsey spending less time at Twitter, seemingly a good thing for Twitter investors. That stock is up by 11%. And Jack Dorsey potentially spending more time at Square, seemingly a good thing for Square investors. Make of that what you will. Square up by 3.6%, Twitter up by 10.8%. That's some of the broad price action right here, with energy up by 2.9%, information technology up by 1.8%. This is a broad-based rally. Staples, bottom of the pile, as you might expect, with utilities and healthcare trading. Healthcare up by about 0.6%. The overall index advancing a little more than 1 full percentage point on the S&P. Morgan Stanley's Andrew Sliman was with us a little bit earlier. This is what he had to say about the complacency he still sees in financial markets.
There's a lot of complacency. The market's done so well this year. Yes, I understand the market was down a lot on Friday, but I saw retail money coming in. People are buying the dip. And so high levels of complacency. So I don't think, we'll get a bounce back, but I don't think it's going to be, dramatic because of that kind of complacency to this issue over and over. So if it morphs into something more serious, that could be a concern.
You've got to bounce back by a little more than 1%. With us for some early thoughts around the opening bell, Greg Peters, Emily Hill, Jack Caffrey. Emily, you've made this point. The US equities have captured 5 to 6 years of returns in 1 year. Can you walk me through how you're adjusting your return assumptions and how much caution you think we need to have around that story?
Yes, if you look at the CAPE cyclically adjusted PE ratio, the only time that US stocks, US large cap stocks have been this overpriced was in 2000. So yes, I think frankly the value is in cyclicals, US value stocks, international stocks, which are trading at a 30% discount to the US stocks. and and some selective stock picks among small caps. So I do think it's a little bit too early for emerging markets, but I think most investor portfolios have become highly concentrated in tech and in U.S. large cap growth. And that's because, some of the FANG names and the 15 to 20 stocks that have been driving the S&P 500, investors have decided that they're immune to whatever happens in the economy. And at some point, there will be a catalyst that that brings these stocks back to a value that's more appropriate. The question is, as Andrew Slimmer pointed out, these retail investors are very aggressively buying the dip still, and I see that continuing for a while. So, it may be a while before we see the kind of correction that I expect to happen eventually.
Jack Caffrey, I want to come to you on that in just a moment. Just one final question to you on this, Emily. What you just said about international versus, say, the United States, what you just said about tech, could have been true for much of the last 10 years. Why do you think it should matter, will matter, over the next 12 months?
It may not be over the next 12 months. I remember saying in 2007 I was wrong for a year and a half before we saw a big correction. So it could be longer than a year. I think there are reasons that these tech stocks have done as well as they have. We're seeing increasing digitization. The pandemic really accelerated that trend. And I'm talking about the Microsofts, the Apples, the Facebooks. But, eventually there will be reversion to the mean. That's just the way it happens. And so, frankly, but it will take some major catalyst. And I think one of the things that we've seen, and I've said this before, retail trading volumes in the market were around 12% of total volume in 2019. That's now more than doubled. It's about a quarter of trading volumes. And I would argue that a lot of these traders, a lot of these individual investors learned a bad lesson in the last bear market, which is that the Fed is, that if a bear market lasts 3.5 weeks and the Fed's going to step in and bail everybody out, and any kind of big downturn is a buying opportunity. And I think if any kind of bear market that many people have been through, something that continues for 6-9 months or longer, you're going to see those retail flows reverse.
Jack Caffrey, your take.
I think one of the most important questions an investor has to ask is who and what is the marginal buyer in the equity market. In the 80s, it was the mutual funds, and that continued well into the 90s. We felt like there was a transition perhaps towards hedge funds in the early 2000s after their glorious capture of protecting capital in the meltdown in 2000. And more recently, that marginal buyer has been really a passive investor. And the challenge of the passive investor is fundamentally those are not mean reversion strategies, but they're fundamentally momentum-based strategies. And so to some extent, you see that being recreated within the market, which starts to look with sector level balances or imbalances that really push to those stocks which were massive beneficiaries of work from home and the disruption that COVID forced on us have been big winners. Have they priced in years of growth to come? They quite likely have. But we come back to, as Emily pointed out, you need some issue that causes us to change our mind. I don't know that retail traders are as aggressive in the large cap dominant stocks that control the index moves as they are in small little off the run issues where they can skew results based on their trading flow. A year ago, none of us wanted to talk about, the meme stocks because none of us had heard of meme stocks a year ago. But now meme stocks are off in their own corner of the market. And in between retail and between quantitative trading and ETFs, I think you've got three divergent sets or passive investors broadly, three interesting divergent trends that may all ultimately demand liquidity rather than provide it. And I think that's really the fun question, which is who's that liquidity provider when all three of us decide something is wrong here.
We'll take another beat on this particular topic. I just want to bring you the early moves. We're up by about a 1% on the S&P 500, 7 minutes in. Staples lagging, as you might expect. Energy top of the pile, up by 2.53%. Greg, just to go back to what Emily said, that retail investors, new entrants to this market, to the equity market specifically, have learned the wrong lessons recently. Is the same true of credit?
Look, I think all investors have been rewarded by quote unquote buying the dip, being bailed out by central banks, so on and so forth. So I don't think it's just retail. I don't think it's just U.S. equities. I think it's more broad. And so it takes us back to where we started this conversation at the top of the hour, which is there still a Fed foot in play, so on and so forth. And I think that is the question on the table. Stated differently, it's all about interest rates as well. So I think these risk markets need interest rates to remain low, real rates to remain negative in order to keep the party going. So to me, it all comes full circle around interest rates, real rates, and central banks.
And a big meeting on December 15th. Looking at the early moves, the airlines leading the early gains, rebounding after recording their biggest day of decline since 2020 on Friday's session. Katie lied, it was brutal.
It was absolutely brutal, and yeah, they may be gaining today, but that doesn't go that far in recovering what they lost on Friday. It's really all about the fate of the reopening trade as we weigh what exactly the Omicron variant means for the recovery. Of course, we did get a read on what the reopening had looked like to this point with Black Friday on Friday. You did see traffic up 48% from 2020 levels, but still that's 28% below 2019 pre-pandemic. So clearly there is more work to go, and you've seen that showing up in the performance of department stores over the last week. They were caught up in that reopening trade selling that we saw at the tail end of the Thanksgiving week. And of course, the likes of travel also getting wrapped up in that. The airline's still down 6.6% over the last 5 days, even with the gains we are seeing this morning. The hotels also under pressure, and the stay-at-home index, yes, more insulated, but even it too has not been spared over the last week. And when we put all these moves in context, John, we do have to consider that, yes, the recent drawdown for reopening stocks, represented here by Goldman Sachs' basket of reopening plays, has brought them down around 12% from their pre-COVID levels, but we are nowhere near the depths of the declines that we saw in 2020. At one point, they were down 57% from that level, John.
Kelly, thank you. One more name I want to pick up on is Twitter. Talked about it a lot over the last 20 minutes or so, confirming here at Bloomberg with our reporting as well that Jack Dorsey is stepping down as the CEO of Twitter. CNBC first with that news about 20 minutes ago. The stock move fading just a bit. We're up by 6.8 percentage points right now. Call it 7 percentage points higher, 7% higher on Twitter. Square up by about 1.66%. Square up by about $3.50. A story we'll stay on top of through the day on Bloomberg TV and on Bloomberg Radio. Sean Darby of Jefferies expecting Omicron to fuel some major price swings and betting on volatility, writing, quote, "It will be the best asset class in 22. We expect a further unwinding of flows from risky assets into safe assets after risk appetite reached seemingly insatiable levels." Greg Peters, Jack Caffrey, Emily Hill still with us. I want a final word on this from all of you. Emily Hill, do we have to get ready to tolerate higher levels of volatility, given the conversation we've had over the last 40 minutes?
You know, it's really hard to say because I think a lot of it depends on Omicron and how serious the symptoms are. Often when a virus becomes more infectious, it becomes less lethal. So if it turns out to be like the Delta variant, if you look back to when the Delta variant was announced and when people generally accepted, okay, we've got a problem on our hands, it was a blip, really. It was a blip in the treasury markets. It was a blip in the equity markets. It was a blip in trading volumes. And I think if we find that this new variant is not more lethal, this will turn out to be the same thing.
Jack Caffrey?
You know, I do think volatility is going to be large and more substantial over the next 6 to 9 months. We're talking a lot about the economy. We're talking about the Fed reaction function. We're talking about the Omicron variant. I kind of want to know who's going to be running all of the Federal Reserve 6 or 9 months from now. We have 3 vacancies still to be filled, and are they going to be inflation hawks, inflation doves, regulation hawks, or regulation doves? And I think that is going to be perhaps a more impactful discussion to be having. But I do think that when I look at high expectations across credit, across yield investors, across equity investors, we don't have as much room for error as we might have had in the past.
Greg Peters, final words, sir.
Follow-up.
Yeah, so I think it's important to note that you've already seen heightened volatility within the fixed income market. You haven't seen it in the equity market. So I think a call for higher vol in equities basically is quite negative for risk, full stop. So if you think volatility is on the rise for equities, then that is bad for credit, it's bad for equities, and it's bad for the broader markets. But do note that fixed income has already seen elevated volatility. It just hasn't seeped into kind of the overall risk marketplace as of yet.
A really good point, Greg. It's good to catch up, sir. As always, Greg Peters, Jack Caffrey, and Emily Hill, thank you very much to you as well. Something Emily mentioned at the end there about maybe this turning out better than okay was something that Bill Ackman, hedge fund manager here in New York City, had to say out on Twitter as well when he wrote, well, it's too early to have definitive data, which it is. Early reported data suggests that the Omicron virus cases are mild to moderate symptoms, less severity, and is more transmissible. If this turns out to be true, this is bullish for the equity market and bearish for the bond market. Of course, it is still too early to be definitive about any of this because we don't have the data, but it's interesting to understand how a market would respond to the kind of scenario that Bill Ackman described. Something to talk about potentially through the week. Coming up, OPEC Plus delaying its meeting to assess the new threat from Omicron.
The lockdowns that we're starting to see and the potential pending lockdowns is probably much more concerning to OPEC. I think this is the reason why they've taken a very cautious approach. Their strategy is actually being redeemed here.
That conversation is up next. This is Bloomberg.
Young woman that's watching this wants to be the next Diane von Furstenberg, what would you recommend?
Be as true to yourself as you possibly can. The more you could be you, the happier you will be.
Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
The
They've been talking about the winter. They've been talking about, look, there could be potential mobility restrictions. This is why OPEC Plus have been cautious. This is why OPEC Plus have been very clearly only increasing production by 400,000 barrels per day. It does call into question why the White House and other consumers released SPR going into a season which is bound to have uncertainties around demand.
OPEC Plus delaying its meeting to later this week, with Russian Deputy Prime Minister Alexander Novak saying the group is looking for, quote, more information about the current events, including the new virus strain. Bloomberg's Julian Lee joins us now from London. Julian, given what we know and what we don't know, what on earth do they do this week?
Well, they try and gather as much information as they can. The meeting that they have postponed is the technical meeting and the sort of subcommittee of ministers that puts recommendations to the full OPEC Plus gathering, which is going to take place on Thursday as originally scheduled. So what they're doing is they're allowing their analysts more time to gather information from the World Health Organization and others about this new variant and about and do their own analysis about the impact that it might or might not have on demand before they make a decision on how to respond with production targets for January.
Have you seen these price targets out of JP Morgan this morning, Julian?
I have.
125, 150 on Brent next year, the year after. What was your reaction to that?
I think, this is very clearly based on a very, if you like, dismal assessment of how much spare production capacity there really is within the OPEC Plus group, how much of that can actually be brought into production quickly and, more importantly, sustained for a prolonged period of time. And what they're saying is that that figure is actually about 2 million barrels a day. It's not the 4.5 million barrels a day that seems to be the consensus view. And what that means is that as demand recovers, we are seeing much, much less of a cushion to deal with any disruptions elsewhere or with any stronger than anticipated demand growth.
Fascinating stuff from the team over in London. JP Morgan, 150 and 23, 125 next year on Brent. Julian, good to hear from you, sir. As always, we'll catch up through the week ahead of that OPEC Plus meeting. Wanted to wrap things up with Damien Sassa of Bloomberg Intelligence, and I wanted to do it because we spent the whole morning talking about Omicron, and seemingly, Damien, everything, every short-term outlook hinges on what happens with this strain. If we find out it's more contagious, less contagious, more severe, less severe, stands up to the vaccine, does not stand up to the vaccine, seems to dictate people's outlooks. What's interesting to me, and this came from Peter Cheer, so bear with me, I'm going to read you this quote, because I know you agree with him. Blame Omicron, but I think that was a mere catalyst that just triggered a lot of other things, some of which were already in play. You agree?
I completely agree. I think Greg Peters just nailed it at PGIM also. I mean, we've been calling for weeks and weeks and weeks. We saw the uptick in FX volatility, not just in EM, but in developed markets, largely due to the year-end turn, which is coming up, largely due to euro weakness, but in rate vol, all of these other asset classes. But equity and credit had just, they really hadn't budged. I mean, all it took was a little catalyst, a little event, call it Omicron. It could have been oil. It could have been anything at this stage, but the markets were overdue for a bit of a correction, and I think Friday's price action was proof of concept. I mean, it just needed to get pushed over the edge.
A lot of people trying to work out whether they should fade Friday's move or fade this morning's. Damien, given everything you've just said, what does it mean for your approach to this market?
Well, I mean, look, I do believe that that vols needed to come up, and I think that it needed to come up through the 1 week point, meaning we have a payroll print coming out on Friday, Jonathan. I mean, I think for the equity market year-end rally that everyone's calling for, you need to actually see a weak payroll print in order for that to happen, because it would maybe slower expectations for the taper. But for me, yeah, I think vols, are going to stay a little bit elevated, at least over the near term, 1 week, 2 week. But yeah, I mean, I think things are setting up nicely for a year-end rally in equities, not so much in emerging markets.
Damien Sassa, with a view shared by Greg Peters, Peter Cheer, and Jim Bianco too. An interesting one. Damien, thank you. It's good to see you, sir, as always. Your equity market does bounce back from Friday's losses. Your S&P 500 up 1 full percentage point. Breaking down the sector price action this morning. Here's Kriti Gupta.
Well, good morning, John. You are seeing tech in the lead. Of course, a little bit of that defensive tilt, but also at the top of the leaderboard is going to be energy as well, which tells you it is going to be a fairly broad rally. Folks just buying everything after last week's pullback. Remember, you do also see quite a bit in travel stocks as well. Those are the ones coming back today. fast and furious, partially on news that vaccines are being made to address this new variant. Also seen as volatility play. We heard Greg Peters earlier in the show, and of course now Damian Sassower as well, talking about equity vol catching up to vol you're seeing in other parts of the market as well. For traders betting on that higher VIX, those airlines are going to be something to watch, John.
There's a lot to work out. Critty, it's good to catch up with you, breaking down the sector price action this morning as we do get a lift, a bounce back from Friday's losses this Monday morning. Coming up, the market moving events you need to be watching. We'll bring you the trading diary as we race through the week and head towards Payrolls Friday. From New York City up 44, advancing 1%. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Leanie Oberg is helping Marriott transform itself at a pivotal moment for the hotel industry.
Part of our job is to make sure, what do customers want? What are they thinking that they want next year and the next year?
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Five minutes into the session, here's your bounce back on the S&P 500, up by about 1%. On a Russell, up by 0.8. On the Nasdaq, up by 1.42%. What have we learned so far this morning? We've learned a whole lot that we need to know about a virus that we don't know right now. How contagious is it? How severe is it? And do the vaccines stand up to it? Until we find that out, you can't really get a clear outlook at all on this economy, or for that matter, on a central bank. So what else have we learned this morning? The Fed put us in question. Switch up the board and get to the bond market, 2s, 10s and 30s. And that's what we need to talk about a whole lot more. Greg Peters of PGIM bringing that up earlier in the hour, reflecting, echoing what we heard from Peter Cheer of Academy Securities as well. If the backdrop is high inflation and we get into a little bit of trouble in this market, how much space does the Fed have to step back or step in to help things out? Maybe not much. Yields this morning up 4 basis points on 2s to about 54, on 10s up 8 basis points to about 155.51. That's the price action. Let's get you the trading diary. First of all, President Biden delivering remarks on the Omicron variant at 11:45 Eastern Time, followed by comments about the supply chain later in the afternoon. Fed Chair Jay Powell and Secretary Yellen heading to Capitol Hill to testify before Congress on Tuesday and Wednesday. ISM Manufacturing also coming on Wednesday too. Another round of jobless claims coming up on Thursday. And finally, wrapping up the week with the main event, it's Payrolls Friday just around the corner. How sensitive will we be to that incoming economic data as we wait for more answers to questions about Omicron? From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging. We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I look at the opportunity we provide, and providing access to information and knowledge, I think we'll end up being on the right side of history as well.
Financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
Drugs to the rescue. Pfizer starts work on a vaccine for Omicron, and Moderna promises one early next year. Both stocks popping this morning. Markets calm down, but restrictions do not. Equity is clawing back some part of the losses from Red Friday. Bond yields soar. Travel stocks, though, lag behind as curves fall into place. And $150 oil, that's coming. Prices rebound while OPEC delays its meeting. We're going to talk to the analyst behind that 150 call in oil for 2023 as spare capacity shrinks. Christian Malik of JP Morgan will be joining us. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I was out of pocket for 2 days, knee deep in baking. I see the price action. I see the headlines on Friday. And my first instinct is that who was trading that day? Thin liquidity. Let's wait for the expected bounce Monday morning.
Do you know what? Actually, volumes were okay Friday, so I think a lot of people in this new world of being able to work from home did actually step in. I admit it was a shortened week, a shortened session, and as a result of which, we may have seen some people not there. But nevertheless, certainly here in Europe, it was a high volume session. Look, is it a bounce back, a dead cat bounce? Call it what you will. I don't know yet. Alex, I think until we know the details around what this new variant is going to do to us, then I think that answer is pending.
Yeah, or did it just take some froth out of the market, which we were kind of expecting and kind of waiting for that to happen towards the end of the year anyway?
I think that's a perfectly legitimate way of looking at it. You've seen vols pick up in foreign exchange, you see vols pick up in fixed income. Now we see it in equity, and we now see it in credit. So maybe that was going to happen at some point. So yeah, I think it was inevitable that we were going to have some bumps along the way. We were already, and I think we should bear this in mind, we were already starting to see significant pickups in Delta. Yeah. It's happening where you are now. It's certainly happening where I am. So that was always going to be a cause for concern. There was likely to be a bump that was going to be major, that was going to offset these equity markets. I don't know what it was going to be. Turns out it was a new variant.
Yep, and also we were already seeing markets in some respects roll over a touch, right? Vol was already picking up. Oil was also rolling over just a little bit. There were already some cracks within all of this, which is worth pointing out as well, which begs the question, like, how much can we actually come back from Friday?
Yeah, though I just listening to some of the commentators that have been on air throughout the morning, they're still pointing to the fact that we're going to see a Santa Claus rally, that we're going to have a run into Christmas, certainly in DM markets. Housing data's just starting to hit the tape. looks a little better than expected on a month-on-month basis. So this is pending home sales data out of the United States. The month-on-month number coming in at 7.5. The survey number just 1%, so a 7.5% pickup. The prior number was negative 2.3. That's been revised a little further lower. The year-on-year non-seasonally adjusted number negative 4.7, though the prior number negative 7.2. So some signs of stability, or maybe even a pickup, Alex, in the housing market.
Yeah, interesting stuff there too. All right, let's go back to Omicron here. The doctor who alerted government scientists to the possibility.
Okay, traders, it's time to place stop for our profit. We're already in profit for for Bitcoin. I'm going to place stop at 57,218. Okay. Please do so. If you started copy my trades, please do so. Please place stop on for your position, and you will not lose anything. As you can see, it's already moved down. We will slowly but surely we will move down our stop as well. Right now, in our case, we already 0.5% in profit. What it means, money-wise, it means £500 in profit. For you guys, it all depends on how much you decided to invest when you decided to trade Bitcoin. I will adjust the price. Okay, and I will put, let's say, I will put yellow line, so people will understand that this is, we didn't close position yet. It's stop for our position, so if it will change direction, it will close the trade. Okay, guys? Stay safe. Good one. I'll speak to you later, guys.
Zelli of Bloomberg Intelligence. Hey, Sam, the market reaction Friday, swift. The reaction by politicians, swift. Should it have been?
Hi, Alex. Yes, I think so. You know, I know that it's not nice for South Africa and some of the other African nations to have flights and travel banned or made very, very difficult. But then I'm also hearing that South Africa is saying that people shouldn't travel between provinces. So I don't know why travel within the country is not a good idea, but travel outside the country is okay. So I think that you just want to slow it down until you know more about it, frankly. And you know, I'm directly affected by it. So, you know, it's something that we have to wait and see.
Sam, at the moment, the financial markets are flying blind. We had a knee-jerk reaction Friday. We're trying to calculate what our reaction is today, this Monday. Can you just walk me through the timeline of how we're going to learn more about this? What are the key milestones that we need to get to?
Yeah, so I would say that what we need to see is in the next couple of weeks, hopefully news coming out of the various companies as to whether their third shot of the current vaccines that they've got induces an immune response that can neutralize Omicron. Remember, they already showed that to us for Delta and Beta. That's number one. Number two, if that's not the case, they've got vaccines against Beta. Does that help? Because Omicron is a bit closer to Beta than it is to other variants. So that's the sort of information I'm looking for, which I think is the first we'll get in the next few weeks. And then, of course, how much transmissible it is.
We've heard a lot of talk so far, Sam, about mild symptoms in order to sort of show that maybe this isn't a Delta-type scenario. Do mild symptoms automatically mean less hospitalizations and less deaths?
To be honest with you, Alex, I don't put any stock in that comment at all at the minute. This is one country with relatively low number of cases, with a much younger population than other countries, different comorbidities, and different levels of background infection. You just can't make a decision on how bad this virus is until you've seen it more broadly infecting people and for longer. So I'm afraid I don't buy that yet, but I wish it to be true.
That would be nice, yeah. I think there's some upside scenarios here, but at the moment, obviously, the muscle memory teaches us to be a little bit cautious. Sam Fazeli of Bloomberg Intelligence, thank you very much indeed. You've just been looking at pictures of Professor Van Tam here in the UK, briefing on where we are in terms of the UK's response. The UK does seem at this point in time to be accelerating the vaccine program, trying to reach as many people as possible, as Alex was saying, urging boosters for all adults, second shots for 12 to 15-year-olds. There's a kind of gap between 12 and 15 at the moment where you get one shot. You also don't get NHS access to prove you've had that shot. So 2 shots may end up changing that. It'll be interesting to see whether they change the reporting standards around that second shot. We're going to have an ongoing response here at Bloomberg to what is happening here. We've got a special coming up later on this afternoon on the Omicron variant and the impact these variants are having. It's going to happen at 4:30 p.m. in New York. That's 9:30 p.m. here in London. Let's talk about the market reaction. Christian Lawrence, Rabobank Senior Cross-Asset Strategist, joining us now. Christian, fairly straightforward first question. We saw obviously a massive rout Friday in credit and in equity. We're seeing a timid bounce back today. What do you make of the price action?
Well, I think the price action makes sense given the circumstances, but unfortunately, Sam was quite right. We just don't know how the Omicron variant is going to evolve, and we really just don't know what sort of impact this is going to have on markets going forward, and indeed on economies going forward. So it adds uncertainty to what was already a blurry outlook. That being said, we have, of course, seen that buy the dip mentality coming in already. December is usually a very strong month for US equities. We know corporate buybacks are accelerating into year end. So outside Omicron, there were reasons to be bullish equities moving into year end, but this does provide that layer of uncertainty for sure.
So does that mean buy the dip, but with a lot of extra hedges?
I think so. In terms of high conviction views, it's difficult to have them right across markets at the moment. What I do have is that I certainly think the US dollar is going to head higher. I certainly think we're going to see higher volatility in interest rate markets. And when it comes to equity markets, look, the mega tech companies have done a very good job of holding up those headlines. The action has and will continue to be below the surface, the rotations into and out of value. I tend to think that at this stage, until we do get more information on Omicron, a slightly cautious approach is warranted. That being said, within the value space, I like financials, I like selective energy, but I'd probably be careful of travel stocks at the moment.
Yeah, I think you're probably not alone in that. Christian, talking of the cautious response, do you think we get a cautious response from central banks as a result of this? What I'm trying to work out at the moment is what impact this will have on Fed policy, Bank of England policy, ECB policy. There is a danger that if it turns out to be a difficult variant to deal with, that we end up seeing an impact on the labour market as we see lockdowns or lockdown lights being reimposed. But if that's the case, then we're likely to see also higher inflation. On which way do you think the Fed and other central banks how will they deal with that?
Well, I think central banks in most developed countries are really stuck between a rock and a hard place, and that counts for the Fed as well. We've seen massive repricings of the front end. I think we continue to see that as we get to grips with the strength of this recovery. And the labour market is a key part of that. There's a lot of focus on the unemployment rate, but of course the participation rate has fallen a lot as well. And that hasn't surged back higher. And we don't know how many people have left the workforce for good and how many will be forced to return to the workforce earlier next year. I tend to be of the view that the wage growth we've seen this year has been more about distortions and that it's less likely to continue as we move into next year, particularly as we see some more Americans forced back into the labour force. But when it comes to the Fed, I tend to think they're going to be pretty cautious. I don't even buy the idea that they'll necessarily raise rates twice next year. I think we may well only get one rate hike next year. And as for the tapering process, well, I tend to think that they're going to stick with the pace that they've already outlined rather than stepping that up at the December 15th meeting.
Yeah, and Goldman, though, before Omicron came out, increased their forecast for rate hikes, three starting in June for 2022. So, Christian, what was really interesting is that before all of this, the idea that we were going to get a rotation into value cyclicals and small caps was kind of permeating in the market. Whether or not that was coming true is a different story. Does that push this out altogether, and then you have to go by the safety and the growth of the big tech, or can you start to play with that rotation?
Well, I certainly like the mega tech companies at the moment. You know, they have been a stronghold, and I think they'll continue to be. When we talk about value, I think it's more about being selective. You know, investors that can be agile in this environment, they're the ones that are going to be outperforming. And it is back to that old-fashioned environment of stock picking to an extent as well, I think, if you're going to weather this storm. But of course, you know, Fed actions will remain key. If they do step up the pace of tapering, then I think that will take the wind out of a lot of the growth stocks. But as I said, that's not really my base case. I think the one thing that central banks are going to want to avoid is a policy mistake. You know, look at the ECB back in 2011. They've never been able to raise rates since. And the last thing the Fed wants to do is raise rates and then be forced to unwind that. So I think the middle of next year, even that is too early to really start to put the pressure on rates from central banks and for the Fed in particular.
Hey, Christian, we really appreciate it. Thanks so much for joining us. Christian Lawrence, Rabobank Senior Cross-Asset Strategist. Thank you so very much. All right, coming up, we're going to stay with this story, how the latest COVID variant is going to wreak havoc on air travel. We saw those stocks get hit really hard on Friday. They're shaking off some of those losses and the turbulence today, but still the outlook not so great. This is Bloomberg.
You should be thinking about formerly incarcerated people as representative of their families also and of their communities. These are human beings. They're not disposable items. They are not to be warehoused, locked away, out of sight, out of mind. And so I'm out here in the public because I am the conscience of those folks of America, I hope. I'm hoping to prick their conscience and know that I am just a symbol of a much greater problem.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Omicron variant weighing on those travel stocks. Airlines trying to bounce back today, but they took a pretty big beating on Friday. Bloomberg's Ed Ludlow has more. Ed, we were talking about the rotation with value and small caps.
Right.
Let's talk about the reopening and the travel stocks.
Yeah, 40 minutes into the US session. It's actually a mixed picture, right? Some softness in United and American Airlines, strength in actually other stocks like cruise ships, Carnival up 0.5 percentage point. And then you're looking as well at Expedia, which was one of the hardest hit Friday. Compare that with the European session, and we did actually see a sustained rebound throughout Monday's session so far. The question being, where do we really go from here, right? Morgan Stanley out with a note saying that this is a sector that is so vulnerable to volatility because of the news cycle. What do we actually know about this variant Monday morning more than what we knew on Friday? And that's the point that Morgan Stanley makes, that as news comes out, expect these types of stocks to move. If you bring up the stock 600, index travel and leisure subsector. You also make the point that even though we've seen a rebound Monday, particularly in Europe, over 2 sessions, we're still in high single-digit declines. And there's an idea of whether this is priced in or not. You've got Citigroup talking about the UK in particular, whose measure has been to reintroduce PCR testing and mandatory self-isolation until you return a negative test. They look at the market, they look at the industry and say, yep, continental Europe's going to follow suit. That is a headwind to demand going into the Christmas period, demand that was waning already. I also want to talk about Asia really quickly. We've got a rebound in Europe, but if you look at the BI gauge of airline stocks in Europe, the yellow line, we fell for a second consecutive day. And if you look at some of the measures that are being enacted in Japan, in Singapore, in the Philippines, they moved very quick and very severely. And it's Asian airlines that have outperformed this year relative to the white and blue lines, which of course are Europe and the United States. So we don't know much about the variant, but there are different reactions with different pace in different regions. Hard to keep up.
Yeah, hard to keep up and hard to make booking plans. Ed, thanks a lot. Bloomberg's Ed Ludlow joining us there. Guy, I'm assuming you've had to change some vacation plans.
As ever, but that's just the new normal, isn't it? You book something, then you have to change it. The airlines generally are getting better at it, but if you want to book ski lessons or if you want to book transfers, all this kind of stuff, that's money you're basically putting at risk. So people are becoming much more cautious. And Alex, I think we did learn something over the last 72 hours, and that is that governments are on a hair trigger, ready to pull new sanctions, new travel restrictions, new problems for travelers forward very, very quickly. And I think that's what the travel sector is responding to here. It's less about, as Ed was saying, the stuff we don't know. What we do know is that governments are responding really quickly to it. Siddharth Phillip, joining us from the Bloomberg travel team. Sid, that's the issue here, isn't it? It's not the fact that we don't know anything, the fact that we don't know we've got a variant we don't know much about. It's that governments have just responded straight away.
Absolutely. So the governments have actually been acting really, really quickly. And that's a problem for the airline industry because it dampens confidence for bookings. And especially as we're getting into the busy winter season where people are getting ready to travel, that's the busiest season outside of summer. And so the airline industry was really hoping for some sort of turnaround this winter. And that looks like it might be hard won because while we don't know much about the variant, governments are reacting really quickly, and obviously that means consumer sentiment is pretty weak.
Well, also, Sid, I have to imagine that this is going to push back any kind of business travel as we know it.
Absolutely. I mean, business travel obviously depends on sort of ease of getting in and getting out. And as countries put up quarantine measures and PCR testing and other sort of barriers to entry, companies might actually be less inclined to send people on business trips. And that could see business trips falling, and especially as you get into like the busy conference season, which is typically in winter, that actually might see a big fall.
Yeah, ironically, there's a big travel conference happening in London this week that you and I will be spending some time at. They're having to come up with new plans really quickly.
Absolutely. I mean, organizers are scrambling to arrange for testing for overseas delegates, as well as isolation bays, because the UK has now mandated day 2 tests for everybody. And that includes PCR tests rather than antigen tests. So it is much harder regardless of vaccination status. And obviously, as Ed mentioned, when the UK does something, the risk is that other countries might follow that example.
Hey, Sid, before we let you go, which is the worst airline off right now?
At the moment, it really looks like a pretty bad news across the board. So I think the long-haul carriers will be harder hit because they tend to be impacted by government rules and restrictions. So the shorter haul carriers are the ones that are sort of easier, they have it easier rather than the long haul ones.
All right, Sid, thanks a lot. Guy, I told you should have come earlier. Sid Phillip joining us from Bloomberg. Now he's never going to get to New York. You're bad. Could have had my croissants and beer. All right, coming up, Twitter CEO Jack Dorsey will be stepping down. Trading the stock is halted right now. We'll break that down even more. This is Bloomberg.
front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
England reporting 2 further cases of Omicron within the last couple of minutes. We'll keep you updated with that. Live from London, I'm Guy Johnson, Alex Steele in New York. This is Bloomberg Markets. One of the other big pieces of news today, Twitter CEO Jack Dorsey stepping down. This, according to a Bloomberg source, trading on the shares, halted. But Bloomberg's Dave Wilson is looking at the impact that this could all have. Dave.
Well, we certainly saw the impact once the reports started coming out about what Dorsey's future will be. Shares of Twitter were up as much as 11% in early trading before that halt, which occurred about 20 minutes into the trading day here in the U.S. Still going on. No announcement yet from Twitter. Nonetheless, though, I mean, you got to remember that Jack Dorsey has run Twitter as well as the financial payments company Square since 2015. And over that time, Square has been a much stronger performer. I mean, Twitter hasn't even been able to keep up with its peers among the FANG stocks or the expanded NYSE FANG Plus Index. You know, that's where you find the likes of Facebook, now Meta Platforms, and Google's owner Alphabet. So some direct competition there. You know, beyond that, I mean, you talk about competition. Look at Twitter versus Square over the last few years. You know, Square, the much faster growing company in terms of revenue. Analysts expecting it to more than double this year. I mean, Twitter, you know, they're looking for a 37% increase, which is not shabby, but nothing like you're seeing out of Square at this point. And, you know, Twitter has certainly had its challenges in terms of user growth over time as well. You know, last year adding something like 40 million users. This year, not even half that. Of course, you know, they've had the issue with having to remove former President Donald Trump from the platform after the January 6th riots in the Capitol. You know, so those kinds of issues aren't going away. Things like misinformation and bullying and all the concerns that show up with social media companies affecting Twitter as well.
Hey, Dave, to that point, how does Twitter fare during COVID, particularly in light of what you were just talking about, especially related to its peers, social media?
Well, it just hasn't been able to keep up. I mean, it's not as one-sided as, say, Twitter versus Square has been over time, but it's certainly there. I mean, you look at Google's owner Alphabet, you look at Pinterest, those shares have more than doubled in the last 2 years. Twitter hasn't been able to manage that. And heck, Snap's owner, Snapchat has more than, the owner of Snapchat has more than tripled over that time. So there you go.
Yeah, good point. All right, Dave, thanks a lot. Really appreciate Bloomberg's Dave Wilson joining us there. All right, coming up, more on the Omicron variant here. New York City Mayor Bill de Blasio is speaking right now. Lauren Scott.